It's 9 a.m. here in New York City on this Monday, December 2nd. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks. They're kicking off a fresh month. December trading beginning, however, in the futures, we are seeing some red. After closing out November with fresh record highs and gains of nearly 6%, we are mixed right now to begin this new month. While Wall Street strategists continue to see outperformance in the stock market, investors will have to see how President-elect Trump's policies will impact the economy here. Over the weekend, the incoming president pledged a 100% tariff on countries that shun the U.S. dollar. The next major catalyst for markets will be the November jobs report out this Friday.
An earnings season continuing. Salesforce, Kroger, Dollar Tree, and more are set to report this week. Salesforce's earnings are expected to show slowly improving demand for enterprise software. It also might highlight strong prospects for its new AI product, Agent Force. And for retailers, sticky inflation, that's expected to be a theme in the reports from Lululemon to Dollar Tree and Ulta Beauty.
And Cyber Monday kicks off after online sales hit a record $10.8 billion on Black Friday. According to data from Adobe, with the official start of holiday shopping now underway, we're also looking at some MasterCard data showing e-commerce sales rising 14.6% from last year. However, in-store sales grew only 0.7% as American shoppers take more time to be deliberate following some of the years of high inflation that we've seen. Breaking news crossing the wire in the last hour. Embattled chipmaker Intel announcing the retirement of its CEO, Pat Gelsinger. Gelsinger has retired from the company and stepped down from its board of directors just as the company is in the middle of trying to execute on a turnaround plan. Take a look at shares of Intel here this morning. They are rising following the news here as we're tracking INTC shares this morning. And of course, all across this story, as he has continued to have many conversations over the years with Intel's CEO, Pat Gelsinger, we've got our own executive editor, Brian Sazi, here on set with us. Saz, I mean, you see news like this come across here. Was the writing on the wall, and what was the overall kind of tenor that you got from really speaking with Gelsinger over the years leading to this point?
Well, I am told, a person familiar with the matter, a couple of notes here, that Pat is devastated by the news, but in some respects, I guess, did see it coming. Small team inside of Intel working on this one. It's my understanding that the leadership team at Intel just found out perhaps yesterday evening on this decision. Ultimately, this came down to Pat just losing the confidence, I believe, of the board and investors. And there's really two moments here, or a couple moments that I think stick out here. And you could have seen the writing on the wall, like you mentioned, Brad. First up, when Intel reported a couple weeks ago, they took a $15.9 billion write-down. It's my experience when companies, old school companies like this, take this type of write-down, it's never a good look on the leader making a call on that write-down. It had me thinking back to when Kraft Heinz took down a massive write-down a couple years ago on its various assets, sort of along the same line, so not good. And then look, when Pat came in here, this announcement, when Pat joined the company January 13th, 2021, the stock's down 60% since. And over the time span, while Pat has tried to get more, build a foundry business or a business that is out there making chips for other companies, he's tried to restore the company's leadership position in chips. Since he's been there, we've seen the rise of Nvidia, we've seen the rise of AMD making really powerful chips, dominating the investor story on Yahoo Finance as companies leading the pack on all things AI chips, and Intel has not played in this. I encourage everyone that has been following this Intel story, go back to this press release announcing this decision. It is not lost on me, someone who's been following Intel for a while, that they are focusing on a renewed emphasis on products, renewed emphasis on the consumer. I think the next step will be, it's unclear if it's going to be an unwind of the foundry business that Intel tried to get into the ground, or a pullback over time, but I think that business will be under review by the two interim CEOs, and then of course when a new official CEO is announced, because this has been a business that has sucked up a lot of capital expenditures for Intel, CapEx that could have been spent elsewhere on the business.
You know, so that's two questions here. It's probably too early to tell. Obviously, the one question I think many investors are asking this morning is who is the likely replacement? We probably don't know that yet, given the fact that we just got this news. But I think also just more broadly, given some of the changes that we could see to the business, do you think that this is going to help really restore that lost investor confidence, or how should investors be looking at that?
Yeah, we're seeing a little pop in Intel shares, but the fact you're not seeing a larger pop, it takes a while whoever comes in to lead Intel, ultimately, if it's one of the co-CEOs that were just interim, that were just posted or just announced to lead the company, or if it's someone from the outside coming to Intel, it takes a while to restore confidence. And this is something that Intel mentioned in its press release. When you take close to $16 billion of write-downs and you are taking, you're missing analyst estimates, these things add up, and restoring confidence with investors doesn't happen overnight. It comes after a series of quarters. But as you mentioned, guys, we've been talking to Pat Gelsinger really since day one that he joined Intel. Here's what he had to say about where the company is in its turnaround just about a month ago.
We beat our metrics on Q3 and we raised our guidance for Q4. So really proud of our team for getting so much restructuring done this quarter and still delivering superior financial results this quarter and into the future. The major restructuring efforts that we've largely finished this quarter, we'll say the second phase of the transformation as we move from getting back in the game, and we invested heavily in capacity and technology development and products that were competitive. Now it's time for us to focus on having the financial and shareholder returns associated with those heavy investments of the last 3.5 years. And that's what this next phase of the transformation is all about.
And lost in all this news today is Pat Gelsinger, the human being. This person really came out of college to lead Intel in his early years. I believe he was their first chief product officer. Left, of course, to run VMware, then came back in 2021 to lead Intel. Pat bleeds Intel. He loves his company. No matter what the company has reported, he's come on Yahoo Finance and given it to us pretty much straight. These are the numbers. Here's what I'm trying to do. Loves Intel. So for him, I think this is also a closing of a chapter on his life's work.
Yeah, began his career in 1979 at Intel, to your point. Been there for decades and really see this brand grow. We do know that they're going to be two interim co-CEOs for right now until they make that ultimate decision, David Zinsner and then Michelle Johnston-Holthaus. Sals, thanks so much.
All right, thanks, guys. Appreciate it.
Appreciate it.
Yep.
Guys, also futures, we're tracking that this morning. We're mixed to kick off the first trading day of December here. We're just outside of 20 minutes from the open of trade. As we head into the final trading month of the year, the S&P 500 is up nearly 30% so far in 2024. And that record year, it may have more room to run here. And it's remarkable, Shauna, especially as we think about some of the gains that we've seen over the course of this year. And really looking at the S&P 500, I saw a stat from Ryan Dietrich over at Carson Investment, who had mentioned that December has been the worst month of the year for stocks only once, going back 95 years, and pointed out the 2018 and Fed policy mistake there. But outside of that, there is still more room to believe, or a reason to believe that there is more room to run here, and what type of permeation that could mean going into 2025 as well.
Yeah, I actually had a chance to speak with Dietrich last week, and he was just telling me about the outperformance historically that we typically do see in December. And I think that's really top of mind here for investors, given the fact that this has certainly been a record-setting year. We come in here time and time again, morning after morning, talking about the fact that we are hitting yet another new all-time high for the S&P, another all-time high for the Dow, another all-time high for the Nasdaq. Not necessarily the case this morning, but that certainly has been the trend this year. And I think many investors are going into the final month of the year asking how much of that has already been baked into the current valuations and what we are seeing. And Dietrich really put this in perspective for me, talking about the fact that, yes, we do likely see outperformance here in December, especially given election years, and this year shouldn't be any different given some of those trends. He was very optimistic about some of the returns that we are likely to see over the next 4 weeks. I also had the chance to catch up with Sam Stovall over at CFRA, and he also put this in great perspective for me, talking about the fact that December is the month with the greatest frequency of advances, so think batting average there, just in terms of how likely we will see gains versus losses here for the days ahead. And also, it's among the month with the lowest volatility, nearly 40% below the average for other months here since World War II. So that's setting up to be yet another month potentially of outperformance. We just had some of those outperformers there up on the screen. When you take a look at December and going back years and seeing what typically outperforms of some of those region sizes, sectors, S&P small and mid cap there, 600, that tends to be up just about 2.5%. The mid cap 400, that tends to be up about 2.4%, followed sector wise by utilities, industrials, and and materials. So again, we certainly have seen this outperformance here in the month of December, and everyone who I've been speaking with, people that we've had on the show too, really telling us that this month shouldn't be any different.
And as we look out into next year, and this month, the activity that we're going to see, to your point, is really going to start to try and best as possible price in what policy might look like from the incoming administration. And as you think about what's been posted on Truth Social or gets posted on X, largely right now it gets posted on Truth Social, from the President-elect Trump, talking about tariffs even, and how some of the different investment houses are really thinking about this. I was looking back to one of the notes that we got just last week when we were talking about tariffs on China, Canada, Mexico being what was rattling around in the markets, and UBS commenting on that, their chief investment office, saying there's fairly muted reaction that they're seeing in some of those overseas stocks as a reflection of the market's focus on core tariff threats, that 60% headline figure that we were talking about then. But then going forward from here, where they continue to advocate for is the threats, saying that it could have some near-term market volatility, but the fundamental backdrop remaining supportive. That at least the view from UBS, and we'll see how far out markets look as they're trying to really price in what we see posted on social media ahead of a changing of the guards in Washington, D.C.
Let's continue this discussion the first trading day of December and talk about what we can expect from the markets in the final month of the year. We want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to have you back on the program. So talk to us just about how you think the setup looks like here for December. Is there any reason to think that we're not going to follow these past historical trends?
Hey, thanks for having me on. You're right, the seasonals for December do look certainly very strong, and there's no reason really at the moment to think that this month should be any different. Now, just focusing back on the fundamentals, though, the fundamentals are really supportive. What we've got is a backdrop of very strong economic growth. We have a Federal Reserve where, yes, there's question marks about how much they're going to cut, but they do have an easing bias, not a tightening bias. And then although we have some of the policy uncertainty ahead of us, generally speaking, a lot of the proposals really reinforce that narrative of US exceptionalism. So as we're looking out around the global space, how markets going to do around the world, the one thing that continues to stick out to us is really our US outperformance persisting through into 2025.
How much of the outlook for 2025 is really based on the U.S. economic growth continuing to remain above trend? And what most notably would that mean for portfolio positioning too?
Yeah, that is key. We can spend so much time thinking about what are the different tariffs, what are they going to play out. But the key thing that's really going to drive markets is whether or not earnings are strong. And for that, you need to have a solid macro backdrop. And as of today, the data is really telling us that the soft landing narrative is still very much in place. So that's going to be certainly very positive. From an asset allocation perspective, we also have to take into consideration that valuations are quite stretched, particularly in the US. There is still a lot of uncertainty globally. So it makes sense that at the same time as having an overweight possibly to US equities, that you do have some exposure to other markets around the world. Now, we wouldn't advocate necessarily for European markets at the moment because they have, I think, a quite concerning fundamental outlook. But other parts of the world, for example, Japan, India, some pockets of Asia, do look really attractive. There's also some space, certainly for credit markets. We do believe that the economic backdrop, as I said, is very constructive. So that should suggest some space for credit exposure. And then through all of this, as we look out to 2025, the key risk ahead for us is on inflation. Is inflation going to take off again? So from that perspective, it makes sense to have some kind of inflation sensitive assets, some kind of exposure there that can provide a little bit of inflation mitigation as we look out to next year.
Seema, even as we look ahead to the latter half of this week with the jobs report, I guess how big of a driving factor do you see that being in investor sentiment here in the coming weeks?
I think it is key for the near-term noise. One of the key things that people are trying to debate is how much is the Fed going to cut? There's even question marks whether or not the Fed is going to cut by 25 basis points in December or not. And one of the key influences of that is going to be the labor market report. But at the same time, one of the things that we have heard from Fed speakers in the last couple of weeks is that they have been emphasizing the distortions from weather-related disruptions, seasonality, which may be affecting labor market numbers. So we're going to look at it, but we're going to probably look through a lot of the volatility. We're really looking for a trend there. The other bit of data, though, which is probably more important, is going to be inflation. How is inflation performing? Is it starting to come down, or are we starting to see a resurgence? I think that's probably going to be the key dictating factor for what the Fed does in December.
How can we kind of gauge how far out the markets are looking based on the performance even in the consumer discretionary sector, considering as we're thinking about where there is still inflationary pressure, the consumer discretionary sector, at least for right now, at least over the kind of past month here, I think we had just seen it rise by 13.2% in November, best month since January 2023. So that would suggest that at least some investors out there are saying, hey, the consumer seems resilient and we're confident enough to look for a rebound, or at least that resiliency to continue in the consumer despite pockets of some weakness.
I think that's really key. And, when we look at the data, we're also seeing clear consumer resiliency. And we're expecting that to persist, but we have to remember that there are pockets of weakness. So the strength that we're seeing is really around the medium to higher income households. Lower income households are starting to see some strains. We're not too worried about it at this stage. Interest rate cuts should help. And overall, when we look to, what is the makeup, the medium and higher income households, they carry about 60 to 70% of consumer spending. So from that perspective, yes, consumer discretionary stocks should continue to perform well. And that is a forecast into next year. So there is some optimism about next year, but we just need to keep an eye. Does that lower income household, does their weakness start to feed through to the rest of the economy? And as I said, that's something that we need to keep a track of as we go into 2025.
Great points and insight, as always. Seema Shah, Principal Global, thank you so much for taking the time here. Shoppers spent a record $10.8 billion online on Black Friday. That's over 10% more than they did last year, according to data from Adobe Analytics. But today, Cyber Monday is expected to remain the year's biggest online shopping day. Adobe expects consumers will spend $13.2 billion today here. And of course, as we're thinking about just where consumers are spending and how more of that is increasingly digital, some of the digital insights here that we're on track to see as well for Cyber Week, they say the 5-day period between Thanksgiving and Cyber Monday, they're anticipating that we're on track to cross a $40 billion mark online and setting a new record for U.S. e-commerce.
Yeah, what's interesting here is some of the trends that Adobe has really called out. And one of the things that stuck out to me, we talk about the resilience here of the consumer, especially the high-end consumer. One of the trends that we are expecting to see today on Cyber Monday, what we have seen really since the start of November, are shoppers buying some of those higher ticket items at this season. So they're trading up to more of those premium goods. We certainly have seen that going back, like I said, to the start of November. And it's happening across categories. This figure is at 78% in electronics, 62% in sporty goods, up 45% in appliances, up 38% in personal care. So you get the picture of people are spending a lot more on some of those more premium offerings. So we'll be interesting to see, and you expect more of a follow through of that here today. And I also think the big takeaway is we talk about the fact that obviously inflation has been very sticky. Yes, people have been weighed down. People have been a little bit more I think discerning in terms of where they are spending, how they are spending their money, but they're still spending, bottom line. And that's clearly evident from the numbers that we've gotten so far from Black Friday, from over the weekend, and the expectations head into today. And I also think that really gives us a better sense maybe of what we're going to hear from some of these retailers. We talk about the fact that earnings season's still underway. We have a number of some of those larger retailers set to report this week. We mentioned Lululemon coming out later on in the week. So we'll be very, I think, insightful just in terms of how investors should be reading the consumer right now. And one thing that we have learned over the past several quarters is that you can't bet against the consumer because they do continue to spend. Yes, we are seeing them pull back in certain areas, but overall we have seen this willingness to spend, and they've really defied many of those expectations and forecasts that we started the year with, started the last couple of years with when we talk about sticky inflation.
Deal seeking though. They're looking for promotions, big ones. The headline numbers from the holiday shopping season, they are impressive so far, but concerns over President-elect Trump's proposed tariffs, they linger in the back of retailers' minds out there. Trump floated a new string of tariffs over the weekend, and earlier today on Opening Bid, Yahoo Finance executive editor Brian Sozzi spoke with MasterCard Economics Institute chief economist Michelle Meyer about the impact and potential impact of those tariffs.
One is around inflation, right? So the cost of intermediate goods will go up. We saw it with the prior rounds of tariffs. The question is how much that gets passed on to the consumer, how much that tariff is shared. That will be a function of how much consumers are willing to also accept that higher price point. So for the items that have tariffs, you could see consumers choose to shift away, buy other items, different, change their basket in a way that they're not as impacted by tariffs. So it'll be interesting to not only look at nominal spending coming out of an environment where tariffs are higher, but also real spending. Do you see a change in volumes because of that increase in price that could be put in place from tariffs?
Now, there is a little bit of a consumer psychology around this too, especially as you think about and hear about businesses who are pulling forward their spending in order to get ahead of potential tariffs. Consumers hear that and they think the same. Okay, if there's a product that I might buy next year, if I see it on a deep discount this year or during this promotional cycle, am I more prone to actually purchase it now instead of waiting until the next iteration or just finding myself in the midst of another large super cycle? But then again, this holiday season, it's been very clear from the retailers that we've heard from that they're concerned about the timing. There's a shortened amount of time between Thanksgiving and Christmas this year, so you have a condensed shopping period. And then additionally here, just price and how that promotional pressure is also going to impact the bottom line.
Yeah, and I think when you take a look at tariffs, obviously that's a 2025, really 2026 story. Yeah. And we've heard it on our program a number of times. Dana Telsey last week telling us that it is going to be a massive challenge for the industry. We also heard from a CFRA analyst talking about the fact that apparel is going to be the hardest hit from potential Trump tariffs. So as you take a look ahead to the retail trade and maybe some of the headwinds facing the retail trade, clearly analysts are already starting to calculate and factor in what the potential tariffs are going to be here on the industry.
All right, I got to get up on my white elephant gifts, I guess, today while there's some cyber deals. Guys, coming up on Morning Brief, we'll count you down to the opening bell on Wall Street as December trading kicks off. Stay with us. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Stellantis CEO Carlos Tavares abruptly resigning, citing different views from the automaker's board. This is after the company issued a profit warning in September. Stellantis saying it will announce a replacement CEO in the first half of next year. Yahoo Finance's Pras Subramanian joins us now with the three things the next Stellantis CEO needs to focus on. Hey, Pras.
Hey, Brad. Yeah, life comes at you pretty quick in the automotive world. 1 year, last year, Tavares was a rock star in the industry, record profits. Now he's out. Stock slipping here. We're concerned what's happening, what's going to happen next. But be that as it may, there are three things that I think need to be done to right the ship here. Let's start with inventories and pricing. The automaker and dealers here had a glut of inventory and heavy cost cutting ate into profits. Too much production, they said, and now those heavy incentives are actually also hurting the brands. So the company made progress on that in Q3. The big question is, can they keep it up? Addressing struggling brands. I think you and I have talked about this before. Dodge, Chrysler, Fiat. Dodge only has 2 cars on sale here in the U.S. Chrysler has 1, a minivan. The Fiat is selling a 500 compact EV with just over 100 miles of range. These products are not working in the US. They got to change that up and possibly kill some of the brands that may not be making a difference for the automaker. Finally, labor issues. Despite signing that big labor deal last year, Stellantis is still embroiled in controversy, most pressing the status of the Belvidere plant in Illinois. The UAW says that they violated agreements. Sorry, my dog is a little bit excited here. Violating agreements on that plant. Products like an auto parts hub, a stamping plant, assembly plant are all in limbo. Toledo cut to one shift as well. The UAW says this violates their contract. So the new CEO and manager need to come in, clean that up, and tell people what's going on. Work with the UAW, even make good on their commitments so investors in the market have visibility into the automakers' pressing issues.
All right, we'll say, all right, Supermanian, thanks so much for breaking that down. We want to get to some of the breaking news out this morning. Shares of Supermicro this morning are in focus as the company announces its CFO is going to step down, but also announcing, this is the big news here this morning, external review of its business by a special committee of its board and also external counsel. It actually found no evidence of wrongdoing. You're looking at the stock drop just about 7% here in early reaction to this news. A couple of things to unpack here. We talk about the impact of the review, and the company saying that the review was completed by a special committee of its board alongside more than 50 attorneys there. They found no evidence of wrongdoing. Their CFO, again, is going to be replaced. Ken Chung, the former vice president of finance, he will be the company's new chief accounting officer. And this has certainly been a tough year, to say the least, for Supermicro. If you take a look at the shares here this morning, at least in early action, we're trading right above $32 a share. If we can actually show a year-to-date chart, you can see how far we have fallen from the highs that we hit back in March. And this is a stock that is certainly really plunged to the downside here over the last several months. They missed that August deadline to file their annual financial report, and also their auditor, E&Y, resigned in October, cited some concerns about the company there going forward. So here we have, I believe this is a 3-month chart. So the year-to-date chart will give us a better picture just in terms of how far we have fallen from the highs that we have seen back in March.
Yeah, year-to-date, we're taking a look at the chart there on the screen. And year-to-date, still holding on to some slight gains. However, it comes with the backdrop, of course, of the Hindenburg research report that was published in August. That was one of the kind of knockout blows to get it to this point, and struggling now to return to some of the levels that we had seen back in March, as you were mentioning a moment ago, where it was alleged back in August that Supermicro essentially had some evidence of accounting manipulation, sibling self-dealing, sanctions evasion at an AI high flyer, as Hindenburg had called it. However, the company now bucking back after this external review, and then ultimately among the findings, the independent special committee determined that the resignation of the company's former accounting team and the conclusions were not supported by facts examined in the review as well here. So ultimately here, we'll see how investors continue to either shrug this one off or continue to say, we'll see what this new team brings for the company.
All right, we'll keep right here on Yahoo Finance. We've got the opening bell coming up next.
There we're taking a look at the opening bell at the New York Stock Exchange, where you've got Gildan ringing the opening bell. And at the Nasdaq, you've got Dogman, of course, Scholastic, I should say, ringing the opening bell there. But celebrating Dogman, as you can see on the far right side of your screen, Dave Pilkey fame. Also, Captain Underpants writer and author, of course, for many of you millennials out there that may remember that book. Anyway, taking a look at the U.S. stock futures as we begin today's trading activity. You're taking a look at some slight gains across the board as we're taking a look at the Dow, the S&P 500, and the Nasdaq. I'm going to bring up the Dow and populate this chart for you here. I'll give you a year to date just to set up December here as we're beginning a new trading month, the final trading month of 2024. And we're taking a look at year-to-date gains over the course and to this point of the year, up by about 19.25%. We'll round that off to for the Dow Jones Industrial Average. However, to begin today's activity, we are higher by about 0.2%. We'll round that off to Nasdaq Composite seeing some fractional gains as well to begin the trading session and the new trading month. That's up by about 0.3%. And the S&P 500, you're seeing some fractional gains there by about 0.2%. Take a look at that year-to-date activity, up nearly 27% for the S&P 500. Since we mentioned the S&P 500, let's take a look at the 11 sectors here for the S&P 500. We've got that pulled up on your screen, so you don't have to go looking for them. XLRE is pulling up the caboose. That's down right about now by about 0.7%. But consumer discretionary coming off of a gain in November to the tune of about 13%. And here you're taking a look at some fractional gains to begin today's trading activity, as well as that is higher by about 0.9%. And just briefly, because it is Cyber Monday, let's take a quick look at some of those retail names here. And I won't go too in depth into them, but we are seeing, of course, for one of the major behemoths, the behemoth in e-commerce, you're seeing Amazon higher by about 1.6% here on the day. Now, for a deeper dive on today's opening cross and what's taking place early in trade, let's get to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Well, hey, Brad, thank you for that. And you did an excellent job going over the indices here. I don't have a whole lot to add. I'll just keep the year to date on the S&P 500 and 26.74%. We are having the best year since, I think it was 2012. Don't quote me on that, but almost the best year of this century. And that was just very unexpected given the election year dynamics that we saw. Those bearish seasonality plays, they didn't play out. And that was only for 1 month. So let's move on here. I was noting, and I've been tracking the U.S. dollar index and the 10-year T-note yield. We'll begin with the 10-year. That is up 4 basis points today. The critical level to watch is up here at 4.5%. We still got a 28 basis point buffer until then, but we don't want to see rates heading above there. And very similar story for the U.S. dollar index. We don't want to see those above recent highs, but that is a lot of indications pointing toward a higher U.S. dollar with all the incoming administration policies, but we don't want to get too far ahead of ourselves. And yes, consumer discretionary has just been a juggernaut. And let's just take a look at the trailing month here in the sector land. Consumer discretionary up 12%. That is by far and away the leader. Financials up 10%, energy up 8%. But what I wanted to check out here is semiconductors, because we got all this big news with Intel, Pat Gelsinger stepping down, and I wanted to show you what the stock has done as over his tenure there. And this is measured from January 12th, 2021. That's when we first got the report that Gelsinger would be taking the helm there. But you can see the stock is down about 53% over these 978 trading days. And then he officially took the reins up here on February 15th. Stock is down about 60% from them. And I thought it was interesting, too, just to kind of track all the other semiconductor performance in there. And this measures since that January 12th, 2021 date. You can see Qorvo down 61%, Intel there's at 53.6%, but also Skyworks down 44%, Mobileye, which wasn't even a stock back then, was down as well. But for the most part, we've seen just these incredible gains. Supermicro leading the pack, up 1,040%, even with the news notwithstanding this morning and all its recent troubles here. Nvidia up over 900%. And then you got Broadcom stepping down steeply for about 264% worth of gains. All right, I got a little bit of time left, so I just want to focus on crypto and show you what Bitcoin is doing this morning, and was not able to pop over 100,000 yet again. Here's the last, well, we're going to do the same time frame here. I want to check out the year to date. We have just been camping out here near record highs, basically 90,000 to 100,000, but haven't been able to punch through. We'll see if there's a catalyst that can bring it over that mark this week, guys.
We'll see. All right, Jared, thanks so much. So now for today's strategy session, U.S. stocks are trading at record highs, and there are some stocks that were overlooked by investors this past year. So what are the 3 trades that you need to buy or at least keep in mind as we head into 2025? We want to bring in Kim Forrest, Boca Capital Partners founder and chief investment officer. It's great to have you here, Kim. So let's talk about what some of those trades are. How should investors be thinking about repositioning their portfolio as we head into the new year?
Sure. Well, I would look at that super semiconductor space and make some adjustments. Maybe if it's a taxable account, waiting until next year if you want to pay taxes on next year. I'm a very tax sensitive sort of manager. But seriously, it feels like semiconductors that are targeted on AI seem very overweight, and you should take a look at that. I think the small caps, and by that I mean companies that have a market capitalization of $1 billion or more. The super small caps, I never tread into there. It's not very liquid, and there's lots of reasons why I don't like really small companies. But those mid-sized companies are kind of unforgotten recently, or forgotten recently, and they're also misunderstood. A lot of the lore on Wall Street says that mid-cap companies and small-cap companies mostly serve their where they are founded in the U.S. And I disagree with that. I think a lot of the mid-cap are global companies, but they're niche companies serving their customers well in one specific area, although globally. And I think those are the ones that you should be on the lookout for.
As you think out to 2025, of course, the mind naturally goes to what we've seen really permeate throughout social media, which is the threat of potential tariffs, and President-elect Trump talking about those and how that will be leveraged either as a negotiating tactic or to make sure that there's safeguarding of U.S. assets one way or another. Investors have to think about that. What is your playbook for tariffs?
Sure. Well, I think the obvious large retailers, that really depend on imports from China in particular. China seems to be probably the biggest place where tariffs are going to be increased, either in volume or in the, actual number or, the percentage. So I think China is an area of caution, and it has been for a while. So I think that's one area. But I think what we've seen in the last week, especially with Canada and Mexico, that it feels like tariffs are largely going to be used as the bargaining chip to get countries to change their behavior towards the U.S. And so I think that's how you have to look at your portfolio, stock by stock, area by area, and make an educated guess.
Kim, what about the AI trade? Is that going to continue to work? Are there signs of a bubble? What is your read just on where things stand?
Well, your last segment had, super micro, which I don't know. Nobody knows what the truth is, right? Hindenburg had some good points. It's always an issue if your auditor bails on you. This is a really big issue. And even though the company came out today and said, a third party has looked at certain areas and they're not seeing the same thing that the auditor did, I've never in my 25 years been wrong about following the auditor. So pay special attention to Supermicro because of that. But it does feel like companies that have benefited may not be the beneficiaries forever and ever. And I think that, there is some bubble activity there. I know whenever I use OpenAI, it's kind of like using a bad intern. I really have to examine what comes back to make sure that, everything I've asked for is actually true. So there's still things to be worked out. And this technology always takes longer to develop than investors want.
Kim, just lastly, while we have you here, as you think about diversification in your portfolio, are we at a point where that diversification also includes cryptocurrency? I'm
really hesitant on crypto. And it's one area, I've been wrong, but it really does to me feel like gambling. We'll pick on Bitcoin. Bitcoin isn't used really for transactions. Bitcoin goes up and down based on a lot of things, but it feels like whenever China is tamping down on its currency controls, crypto sort of goes up then. I'd pay attention to that. And my thought is, until I can pay taxes in whatever crypto coin is out there, it's not real money. So I just take a real hard look at that and understand what you're getting into when you're buying crypto.
Kim Forrest, who is the Boca Capital Partners founder and CIO. Thanks so much for taking the time.
Thank you.
Certainly. Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Intel amid the news of CEO Pat Gelsinger's retirement. Hey, Maddie.
Hey, Brad. So I want to take a look at Intel stock year to date for a little bit of context on this retirement news from Pat Gelsinger this morning here. We've got Intel stock down over 50% year to date, obviously recovering on the back of that news on Gelsinger this morning. I just got a text in from Patrick Moorhead, who is a chips analyst. I want to read this out to folks. He says there's no definitive public reason why Pat has stepped down, so we're left to speculate. He notes a couple of potential scenarios here. One that I think is really interesting is that the board potentially did want to split the company up between the design and foundry business. Perhaps Pat didn't want to stick around for that moving forward. We do know that he had a 4-year turnaround plan for the company. He was heavily investing in that foundry business and appeared to not want to let that business go. He had this 4-year plan to restore the company as the leading maker of the fastest, smallest computer chips. That is, of course, a crown that goes to TSMC at the moment. And that's part of the reason why he wasn't necessarily ready to give up on the foundry business at this time. Now, Bloomberg Intelligence's Mandeep Singh this morning saying that maybe this opens Intel up to take a path forward like an AMD, which did move off its foundries business that's now Global Foundries, that allowed AMDs through Global Foundries to receive government funding for chips manufacturing domestically. Perhaps that is a route for Intel moving forward. If they move the foundries business to an independent entity, they'd still be able to get that chips funding in from the United States here. Also, going back to the texting that I'm doing right now, while we're live with Patrick Moorhead, he said that in the press release, Pat didn't have an ugly quote, so it doesn't appear that it was an ugly split. It appears to be amicable, but as a reminder, he was at the company for under 4 years. Now we have those co-CEOs who have taken over in the interim, which could also be an indication that there was some pressure to make a speedy decision from the board, given that they didn't wait for a CEO who was ready to take the helm at the top of the company as soon as this was announced this morning, guys.
Yeah, Maddie, we certainly have started to hear a lot of chatter or potential talk about the replacement of Gelsinger. All right, Maddie, thanks so much. Coming up, we're going to take a look at Salesforce leading up to its earnings results after the bell tomorrow. We got a preview for you next. Big week for earnings. Salesforce set to report tomorrow after the bell. You're looking at a move just about up about 0.8%. The stock, though, has certainly regained some of that lost momentum over the past 6 months, climbing about 40%. Here with a look at what to expect, we want to bring in Brent Bracelin. He's Piper Sandler's cloud software and analytics research analyst. Brent, I know you recently raised your price target on the stock. You maintained your overweight rating on Salesforce. We certainly did see investors maybe regain some of that lost confidence for Salesforce following the last earnings report that we did get. What do you think we'll hear tomorrow?
Listen, I think it's going to be largely more of the same. And remember, we saw Workday report some tepid guidance. I think it's going to be a similar story here with Salesforce. But the narrative is shifting. And I think that's really important, where people are saying, hey, listen, if this agents and bringing agents to the application layer really works, that could really be a catalyst that could kickstart growth for the company. Probably not next year, but as you look forward 1 year, the more proof points we have on Agentforce, the more likely investors will start to underwrite a recovery. But no, on Tuesday after the close, when the report, expect more of the same, moderating growth. We've seen several quarters of moderating growth. It's still challenging out there. Large enterprises are still trying to experiment and evaluate different AI technologies. You still have internal budget battles. That's not going away anytime soon. But the silver lining here is really around AI coming to the application layer and Salesforce having a pretty interesting strategy and a very aggressive roadmap.
What is that perhaps timeline that you would be tracking up against from where companies are really focusing on, and the biggest customers for Salesforce are focusing on AI experimentation, whether it be through agents or how they're able to leverage their data sets and prompt and query, or whatever the case may be, from experimentation of that all the way into normalization? And how should investors be thinking about that?
Great question. I think what you see now is 2 years of experimentation. Has the enterprise gotten to a point now where they actually feel comfortable knowing what an LLM is capable of and what it's not capable of? A lot of those experimentations were custom experimentations, and what we're seeing now is third-party agents, third-party AI tools bundled with inside of the application. I think what we're hearing from some of those customers is that they would actually prefer the application vendor to bring some of those automation capabilities to them rather than have them having to build them themselves. It'll be a dual strategy. Well, they'll have some custom, some third-party AI applications. But remember, we're coming from a point where people were negative on Salesforce for the last 2 years. There was this perceived threat that a co-pilot would disrupt that application layer. I think what we're seeing now in the last, I'd say, 6 months is this notion that maybe the application layer will be the best place to have these grounded agents that automate very specific functions and workloads. Salesforce has 3 agents that are generally available right now. They'll have another 7 agents rolling out here over the next couple months.
Brent, is this still a tough buying environment right now for the software space? Just taking a step back and looking at more macro view of the sector more broadly?
100%. We spend all our time talking about AI and these new technology trends, when in fact it's challenging out there. And we're actually flagging some risk where we think Salesforce could actually guide CRPO or their backlog to 8% growth in Q4. And the street's looking for 9% growth next year. So there is still risk. We think the silver lining from a financial perspective is free cash flow. So even if growth continues to be challenging, even if growth continues to slow, even if they actually outline a tepid environment for next year, we think free cash flow is really what's going to drive the stock forward for the next year. We do think AI can be a catalyst for Salesforce shares in calendar 26, their fiscal 27.
And so, is Salesforce, or is there another name that is best positioned in at least ERP and software, perhaps cloud, AI, in your perspective? And if not Salesforce, then who?
Listen, Microsoft has a first mover advantage in AI. It's very clear, but you've seen a re-rating there. Microsoft today is trading at north of 38 times free cash flow, looking out basically into calendar 26. Salesforce is trading at 22 times. The 5-year average EV to free cash flow multiple on Salesforce is north of 30. So it really comes down to not who's best positioned, but from a risk reward standpoint, how much of the AI potential is baked into the stock and what's not baked in. That's why we're flagging Salesforce. There's just not a lot of AI upside opportunity baked into the multiple here, and that's why we like the risk reward.
All right, we're going to be watching closely for when those earnings cross and tracking ticker symbol CRM, as we know you will be as well. Brent Bracelin, who is the Piper Sandler research analyst, joining us here this morning. Brent, thanks for the time.
Thank you.
Coming up, everyone, we're hitting 3 stock stories in 30 seconds each. That's next when Morning Brief returns. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, we've got Upstart Holdings and Lending Club. They both got some downgrades from JP Morgan. Upstart cut to underweight from neutral, and this is on valuation call, essentially. The analyst calling the shares priced for perfection. Meanwhile, Lending Club getting cut to neutral from overweight, and the analyst citing preference for other faster-growing fintech competitors like Shopify and Affirm. They're seeing the stock price reaction for both, but ultimately here, despite the downgrade here, it seems like both of the price targets were increased.
Let's take a look at Gap getting an upgrade from JP Morgan, lifting it to overweight from neutral. The change coming after JP Morgan met with management. CEO Richard Dixon over at Gap saying that the company is at an inflection point, moving to continuous improvement from, quote, fixing fundamentals when it comes to why JP Morgan is so positive about the company moving forward. They like this consistent playbook that they think they are getting from Dixon. They actually see Gap at the inflection point to support low to mid single-digit sales growth, also annual operating margin expansion, targeting some of those historical levels of profitability. They're also expecting modest gross margin expansion.
All right, lastly here, we got to talk about Cloudflare. Upgraded to overweight from equal weight at Morgan Stanley here. The analyst writing that they expect to see revenue growth accelerate in the next few years, citing new products, increasing use of AI, and strong sales opportunities. Love the title of this one. Living on the edge of AI, upgrading to overweight here. So ultimately they said, why now? Well, right market, right time, remaining one of the most compelling secular stories in their software coverage universe. Large total addressable market as well, and highly scalable network.
All right, well, that does it for a morning brief this morning. Keep it right here, though. Catalyst coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's take a look at the 3 catalysts that we are watching this hour.
First up, we break down the road ahead for Intel as the company announces the retirement of CEO Pat Gelsinger.
Plus, we look at the potential impact of Trump's tariffs on global financial markets.
And how the president-elect's proposals for mass deportations could impact the labor market. We will discuss.
President-elect Donald Trump threatening additional tariffs against countries that shun the dollar. The moves calling into question what his policies are going to mean for global markets and investors. Let's discuss with Chris Versace. He's Thematica's Research Chief Investment Officer. Chris, it's great to have you back here on Yahoo Finance. We certainly are seeing the ripple effects play out in the currency markets this morning. How are you assessing just what the potential impact is going to be?
So when it comes to Trump, I think we have to remember that, a lot of what he likes to do is to keep folks kind of off balance, if you will, throwing a lot of stuff out there. It is relatively early days. I think he's doing just that, whether or not it's with Mexico, Canada, or now, the BRICS. So I think we need to see how they respond. And so far, it appears that, Canada and Mexico are starting to respond to what Trump has kind of been putting out there. But we do have a long way to go, and there's going to be a lot more that we need to really piece together for the Trump agenda come January, whether it's going to be further tax cuts, tax cut extensions, tariffs, and much more. So I think we need to pay attention, but not take our eyes off the data, because we do have the Fed meeting later this month.
Well, it's interesting. I want to stick on tariffs before getting to the data with you, Chris. I wonder, this 100% tariff threat on the BRIC bloc, does that really come back to China? Is that about a threat to China more than it is about those BRIC nations specifically?
I think it's a little bit of both. Obviously, Trump wants to squeeze China where he can, both directly, indirectly. So I think you're right on that. But at the same time, he wants to make sure that other countries stick with the dollar. That's extremely important. He's been very vocal about that. So I see this more as kind of a comprehensive approach more than anything.
Chris, you mentioned the fact that we have the Fed meeting later on this month. Lots of questions just about what exactly Fed policy is going to look at. Not so much what we hear later this month, but looking ahead to 2025. What do you see as the likely pace of some of those rate cuts?
Well, I think some of that's going to depend on what we learn this week. We get the November PMI data from ISM, the November employment report, and that employment report is going to be, I think, a little more important than usual. Remember, the October report was fairly messy, but I think the other thing folks really want to understand is the updated set of economic projections that the Fed will be sharing when they deliver the next monetary policy decision. And so far, the Fed has underestimated the strength of the economy. They might have to bump up their GDP expectations. If we see that, then the number of rate cuts that they're forecasting might come down. Remember, last time they called for 4, but the market was already seeing only 3 rate cuts between now and the end of 2025. So I don't think the market will be nonplussed by that. If the Fed signals even fewer rate cuts, that would be something that would disrupt the market.
So what does clarity on that path forward look like from the Fed, Chris?
Well, I mean, there's a lot of data that we're going to get before we get to the January, February, March, time frame. So I think pretty much the mood that we've been in of having to watch the data week to week, month to month is going to continue. And, if we examine the landscape of what we've gotten, there's no question that inflation remains sticky, right? We saw that last week. We saw that with the October CPI, PPI data. So if we don't see that coming back down, that would be a little worrisome. And it would say that the Fed can stay higher for longer. The question is how much higher, because I do think the Fed, past a certain point, does want to get back to neutral policy. So they're really going to be data dependent. That's the message.
Chris, what's your top trader? I guess, where do you expect to see some of that leadership coming from then next year?
Well, we've done a pretty good job of isolating companies that are growing their earnings faster than the S&P 500, that have pronounced tailwinds. That's really allowed the Street Pro portfolio to outperform the S&P 500 so far this year, and I think we're going to stick to that knitting. So we've capitalized on, AI, just like a lot of other folks, but we've also looked for other areas that are benefiting, whether it's going to be a pickup in housing as the Fed continues to cut rates, the powerful joint forces of lower interest rates and stimulus spending. That's been very good for infrastructure plays. So that's kind of the way that we're looking at it. We'll continue to modify as more data becomes available, and candidly, as we understand a lot more of what Trump is going to be doing with his policies come January.
Given that challenge moving forward, the lack of clarity from the incoming administration, what is your take on how investors should be viewing specifically what's going on in the yield space? We've been seeing yields coming off their highs, perhaps related to some of the downward surprises that we've seen in the economic data. How are you parsing the impact of treasuries on equities?
So, we've been following it, and if you look really over the last, 4 to 6 weeks, they've actually trended higher. That tells us that, along with the dollar, that perhaps the Fed may not be cutting as much near term as folks had been thinking. So we're trying to position ourselves to take advantage of that. It has us kind of shying away from higher dividend yielding companies, because those become more attractive to us as yields fall, not as yields move higher. At the same time, to the extent that yields stay higher for longer, it questions the renewal of the TINA trade. There is no alternative meeting the stock market. So we might see money stay on the sidelines. So that's kind of how we're navigating that.
All right, Chris Versace, thank you so much for joining us this morning. We appreciate it.
Thank you.
Let's get back to Intel. CEO Pat Gelsinger will leave the job after a turnaround plan he began back in 2021 has sputtered. The stock is down a little over 50% year to date as 2 interim co-CEOs take over. Joining us now to discuss, we've got Olivier Blanchard, Futurum Group practice lead for devices. Olivier, thanks so much for being here for us this morning on this developing news here. Talk to me about what you anticipate the first change moving forward for Intel looking like.
Thanks for having me this morning. Big news, a little sudden. I don't think anybody really saw that coming. So I think that may be something that we want to talk about also at some point during the segment. I think the first thing is to hopefully assure the market that everything is going smoothly, everything is on the right track. I'm not sure that Intel's communication so far on this has been as clear as it could have been. But at the very least, you have 2 interim CEOs right now that are very competent. I think that the very first step, though, is going to be to find the next CEO, the next leader of Intel, and put it on the right path to recovery and growth.
Olivia, so many questions for you here, but I want to stick on the point that you just raised, that it actually came as a surprise to you, because that was a bit surprising to me. Why did you not see this coming?
Yeah, everybody's a little bit scrambling this morning, I think, to make sense of this, because there were no indications, right? It's not like Pat mentioned 6 weeks ago or 6 months ago, hey, I'm going to just go through the 4-year plan and then exit. There were no real clear signs that this was coming. So obviously, a lot of people are busy reading the tea leaves this morning and trying to figure out what exactly precipitated this exit. And there are a lot of good theories about this, right? I mean, obviously, Intel has missed on a few things. It missed on AI a little early, although it was catching up. It hasn't been doing as well as probably the board and investors might like in the last year. But also, I think, for Pat, I think it was a bit of a passion project, and not just being the CEO of a company, but seeing it through. And I think he had a very clear vision of where Intel needed to go. And so for him to exit this quickly, or this suddenly, rather, I feel that there must have been some not misunderstanding, but some differences in opinions about where the company needed to go and how, and that probably had something to do with the business. Some members of the board wanting to split the business between foundry and design. I think that's probably the most likely culprit. On top of just executing quickly.
Yeah, I was talking with Patrick Moorhead, another analyst in the chip space, about that this morning, and he indicated that foundry business being a potential sticking point as well. If the board did want to move forward with the foundry business being spun off on its own, what do you anticipate the impact that would be on Intel from a shareholder perspective?
Well, Intel hasn't been doing as well, as I mentioned, as it could, and especially against rivals like Nvidia. They got a very early start in AI. So I think it would be good and bad. On the one hand, it would prevent some regulatory action that you might see from regulators on Intel just having too much control over the supply chain and maybe seeing some issues there. I think it would make investors happy initially. It would be a huge injection of cash for Intel, for the remaining Intel business. There's no positive or negative here. There's just two different tracks and two different decisions that Intel is going to have to ultimately decide what they're going to do there.
Olivier, what do you think Intel is going to be looking for in its next CEO? How do you see that search process playing out?
That's a really good question. Well, they have two really good interim CEOs right now. Michelle has been at Intel since, I think, 1996. She's run CCG. She's run basically every organization there. She's a proven sales leader. So she's very capable. And then the other one, David, is the CFO. So he definitely has a good take on the numbers. So I don't know. It's possible that they go with one of them as the next CEO. It's possible that they could pull somebody from somewhere else. I don't know. I mean, I think there's a reason that Pat came back 3 years ago to run Intel. It's because Intel's a very difficult company to run. It's a very complicated business, and it's going to be really difficult to find a CEO just from another tech company to come run it. And turn it around quickly. And I think speed here is of the essence. I think that whatever precipitated Pat's exit must have had something to do with the speed at which Intel was making its turn, right, into AI. And so starting from scratch with a brand new CEO who hasn't had a lot of experience with Intel specifically might not yield that velocity that some of the board members who might be inclined to look for velocity are looking for. So I don't know. It's going to be an interesting few months for sure.
To that end, do you think the speed of the turnaround plan is part of the reason that this retirement happened now as opposed to when they did already have a replacement CEO squarely in mind?
It's possible. It's definitely possible. I think, Pat had a 4-year plan. We're not quite at the end of that 4-year plan yet. We've cut it short as of yesterday. So I think, speed is always difficult to execute, especially with a company as large as Intel and as complex as Intel on a global scale. So velocity is, I think Intel was doing fine in terms of speed. I think it still has some crosswinds to deal with in terms of definitely catching up to Nvidia and AI. Also on the client side. Right now, one of the issues that I see is with Intel's new Core Ultra chips being made by TSMC instead of being made by Intel itself is something that's still a year away, I think. So whether Pat had remained CEO or somebody else comes in to take his place, the pace is the pace, and the pace of innovation, the pace of execution is what it is. So I don't think that anybody's going to make things happen much quicker in terms of the product development anyway and the execution of that.
So Olivier, for investors who are not currently shareholders of Intel, what should they be thinking about today? Is this a buying opportunity?
Well, everything's a buying opportunity. But yeah, sure. I think the fundamentals of Intel are strong as a business, and I think that its prospects are still very positive. And a company like Intel is often, I think, not just misunderstood, but I think people sleep on Intel just because it's been a little bit late to the game with a few things and it's had a few misses. But it's an extremely strong, extremely resilient, and extremely embedded company in so many different, really like high growth verticals, whether it's client or data center. So I think. Intel is always a good opportunity. And at the very least with this, you have the opportunity for renewal and an opportunity for change. And that could be a really positive thing, yeah.
Olivier Blanchard, always great to get your insight. Featuring groups that practice lead for devices. Thanks so much for taking the time to join us this morning.
Thank you.
I'm going to get to some economic data crossing the wire. ISM manufacturing data for November showing that manufacturing activity shrank in November by less than forecast as a gauge of new orders moved into expansion territory. That's happening for the first time in about 8 months, also indicating business confidence is improving. Taking a look at some of these ISM numbers a bit further here, we are seeing a bit of a reaction play out in the bond market, most of that being to the fact that we did see prices paid, ISM prices paid, unexpectedly fall here last month. It fell to 50.3 versus 54.8, and they did it while we saw a rise in new orders and employment, both of those figures rising on a month-over-month basis. New orders rising to 50.4, that was versus 47.1, again, the highest that we have seen since March. I also mentioned employment rising to 48.1 versus 44.4. Coming up, we're going to take a look at some of today's trending tickers. We'll give you some of the news behind those moves. That's coming up next on Catalysts. Now it's time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the station. All done with Yahoo Finance's trending tickers page. First up, let's take a look at semiconductor tool makers. They're actually facing new restrictions on exports to China. The U.S. announcing new export controls to slow China's AI development, restricting 24 types of chip-making tools. According to Reuters, the tool controls will hit Lam Research, KLA, and Applied Materials. Despite that, though, you're actually looking at gains across the board here this morning. We're not seeing much of a reaction. I think maybe some of that has to do with the fact that some of these curves were very much expected at some point, just in terms of the crackdown that we have been seeing, the back and forth going on between the U.S. and China. We've seen more and more geopolitical risk or the rising tensions being priced into these names. Of course, it will be interesting to see how exactly the new incoming administration is going to address some of these issues, whether or not we will see more aggressive rhetoric, more aggressive behavior, which is largely expected, I think overall is fair to say, from the Trump administration, given some of that rhetoric that we heard on the campaign trail. But very much there is still a little bit of uncertainty surrounding just exactly what those policies are going to look like.
Yeah, absolutely. And to your point, Shauna, some of it has already been priced in. So whether or not we see a change, which is not necessarily expected, may already be priced into some of these stocks. Just to throw out the other side of things here, a spokesman over in China said that this order from the United States undermines the international economic trade order and could disrupt global supply chains. That has long been the stance of China in terms of these curbs on chip makers, that it could lead to global supply chain challenges. That has certainly been something that the U.S. is willing to overlook when it comes to the importance of domestic manufacturing from these chips names. We do know that the Biden administration has kind of had this large-scale effort, to your point, Shauna, to stymie China's ability to produce some of these chips and access them for both geopolitical and military purposes. It's been important to the U.S. to continue to have these rules here. I should also mention, though, Dutch and Japanese companies have been exempt from this ruling here, so perhaps that's why we're not seeing an impact on some of those names like ASML, for example. All right, well, we are also watching Tesla here offering more discounts and incentives in China to help meet sales goals before the end of the year. For the Model Y SUV, Tesla is offering 5-year 0% loans and a $1,300 discount. The Chinese EV maker BYD is also offering discounts on some of its models. Now, it's interesting, Shauna, we're seeing Tesla moving to the upside. I was hoping to talk a little bit about the upgrades that we got from Tesla this morning here. Craig Irwin saying that Elon Musk's love of Donald Trump could potentially double Tesla enthusiasts. That is a huge amount of potential customers here. And I thought this note from Stifel would be a dream for Elon Musk. They talked about how it's a full self-driving and AI company, quote, clearly not just an automaker. And I believe it was 2 quarters ago when Elon said, don't invest in this company if you don't think that we are a full self-driving company. If you think we're a car maker, then you should get out. So I'm sure he's loving that note this morning.
Yeah, I mean, these are very, very positive reports out here from the street, and that is really what is moving the stock this morning. We're looking at a gain of just about 3%. You're seeing some optimism surrounding Tesla. I love what you just said about the Stifel note. The analyst went on to say that the confidence in Tesla's auto business, significant value creation potential for the company's AI-based self-driving capabilities, as well as cybercab, really underpin the positive outlook on the stock going forward. Say that Tesla is clearly not an automaker, as evidenced by that current market cap. So I think that really just points to some of the optimism that we certainly have seen sweep surrounding Tesla ever since the election results that we did get. We have Musk obviously having a very heavy influence likely here in this incoming administration. Some saying that maybe this could be a distraction, but I think overall many viewing this as a positive here for Tesla going forward. But Roth MKM's analyst there, Craig Irwin, he actually hasn't had a buy rating. Previously had the buy rating on Tesla going back to 2019, but now expecting to see more of a rebound here in growth. And I think that's significant. He's come on the program time and time again, kind of just, I think more so just questioning maybe what the outlook looks like here for Tesla, can be critical sometimes. So again, just a bullish outlook here, more positive outlook, I should say, optimistic here from Craig Irwin is certainly worth noting.
Yeah, he raised the price target by more than 4-fold to 380, up from just 85 there.
Let's get to another trending ticker that we're watching, and that is Autodesk. The design software company beating third quarter earnings expectations last week, appointing a new CFO. The stock taking a dip on the back of those results, although we are looking at gains here this morning, up just about 1%. But you can take a look at that 5-day chart that we have and getting mixed reactions from analysts. HSBC downgrading Autodesk to hold, setting a price target of $290. But there were more optimistic takes out in the street as well. JP Morgan raising its price target to $300 from $245. You have UBS initiating coverage with a buy rating, and also Citi raising its price target to $361. Let's talk about all that and more. We want to bring in Andrew Anagnost. He is the CEO and president of Autodesk. Andrew, it's great to have you back here on Yahoo Finance.
Sean.
Good morning. So when you take a look at least at the street's initial reaction, maybe some disappointment, now we're hearing more from analysts, and they certainly are very positive just about what exactly your growth trajectory looks like going forward. I'm curious what you think is the biggest takeaway from the most recent earnings results and really what that tells us about the demand we'll see in 2025.
Yeah, I mean, so first off, look, we beat on all key metrics and we raised the midpoint of the guide on all key metrics, and that shows a lot of really solid momentum there. More importantly, and I think this is something that people are queuing into, is that in our high growth businesses in construction, manufacturing, and production, we've maintained consistent growth north of 20%, especially in the highly competitive area of construction, which is a huge growth opportunity for us. And all of this is really kind of driven by the underpinning momentum of people need our software solutions, our life cycle solutions to drive more productivity. I think I've told everybody again and again that there's a serious capacity problem in our industries, not enough money, people, or materials to build or rebuild everything that needs to be rebuilt and built sustainably. People need technology, and that secular shift is continuing, and it's only going to accelerate into the future. And that's what you're seeing with a lot of the upgrades. And you mentioned UBS initiating coverage at a 350 target. So there's a lot of optimism. Doesn't mean there wasn't turbulence, but there's optimism, and there should be.
One thing I'm looking at is the outside pressure from activist investor Starboard. Andrew, I'm curious, have you had any conversations with Starboard about what they're looking for from you in the quarters to come?
First off, we talk to all our investors and we take investor feedback really seriously. With regards to any kinds of engagement with investors, I think it's really important to kind of talk about where we agree. And one of the things that we really agree with is that sales and marketing productivity in the company needs to increase. And one of the big goals that we've had over the last 2 years is to change the way we engage with our partners and our customers so that we can drive more efficiency in our sales and marketing efforts. That's why we brought in the new CFO that we brought in. We're very much focused on internal optimization, particularly around sales and marketing. And that's an area that we agree with. And that's an area that's going to be a big focus for us.
I heard you say driving efficiency. What does that mean, Andrew? Is that AI? Is that layoffs? Is it something else?
Oh, it's a mix of everything. Look, efficiency is kind of in our DNA, but it comes down to a lot of things. Obviously, everybody's adopting AI to drive efficiency, but we've also changed how our business is working. So we've got all sorts of redundancies inside some of our organizations that we're going to realign and refocus on other types of things, lighting up self-service, lighting up more capabilities, understanding our customers more deeply, and enabling some of our channel partners to focus on lifecycle solutions. So we're looking at every option to make sure that we drive this optimization, but we've been planning this for a couple of years now. So we kind of know where we're going and we know what we have to do to get there.
Andrew, when you take a look at your billings growth, it was 28%, very impressive. I guess my question is, what does this tell us just about the progression here of your new transaction model and how much momentum we could see in the quarters to come?
Yeah, so Shauna, what you're seeing there is the results of 2 years of hard work. Mm-hmm. That billings growth is the result of the movements we've made from moving from billing annual multi-year contracts up front to billing them annually, and the new transaction model. So what you're seeing is building strength as a result of the changes that we made in our business. And you can expect to see more strength building. We reaffirmed our free cash flow target for next year, which is even a larger target than what you saw this year. So you can expect to see the compounding effects of the things we did over the last 2 years really show up in the business.
Andrew, I'm curious just to get your thoughts on the incoming Trump administration. Lots of talk within the industry just on what ultimately it means for the business. Are you adjusting at all, just in terms of your expansion plans or how you're approaching the next 4 years?
So there's a couple of things. One, I agree with one of your earlier speakers. We just got to wait and see what happens. There's always a lot of talk. But what's really important for our business has really bipartisan types of issues associated with it. Infrastructure is a huge bipartisan issue, and investing in infrastructure globally within the United States, it's something that gets support from everyone. Building housing is a big bipartisan issue. It's something that gets a lot of support from lots of different parties and lots of different constituencies. So when we look at the changing administration, we don't see a lot of change in the things that are really important to our customers. And when it comes to some of the things that are being talked about right now, I really do think we need to wait and see what actually happens versus all the posturing and positioning that's going on right now.
AJ, that's so interesting because you talk about construction, obviously a critical part to your business, housing going forward. We've heard the incoming administration talk about that as well. I guess my question is, do you see it being as big of a priority as it was under the Biden administration?
I think infrastructure will continue to be a priority. I think domestic manufacturing will continue to be a priority. And what that will continue to mean is an investment in manufacturing capacity inside the United States. How that investment happens is likely to be different, but the passion for those challenges and the focus on those needs is going to continue. It's just probably going to have different hows in terms of how they approach these things.
All right, Andrew, we got to leave it there. Thanks so much for joining us. We appreciate it.
Thank you so much.
Coming up, we're taking a look at the top 5 trends for commercial real estate in 2025 and going deeper into today's ISM manufacturing data. All that next on Catalysts. ISM data showing that manufacturing activity shrank in November by less than forecast. The headline number jumping above estimates to highest reading since June. Joining us to break down the latest numbers, we got Tim Fiore, ISM Manufacturing Business Survey Committee Chair. Tim, it's great to speak with you here. So it's interesting, under the hood, the prices paid number dipped, but obviously the headline number surprised to the upside here. Is this a Goldilocks print? How positive is this?
I think it's a little earlier than I would have thought, but it's on the same trajectory that we had projected at the end of last month. So, I've been saying that I don't think we're going to break 50 until the first quarter next year. My last comment last month was probably February. It could very well be January. And the reason I'm saying that is that the new order level finally got back to expansion. We haven't seen that in about 9 months. We're slowing our employment, our layoff activity. It appears that we're investing in manufacturing inventory in the month of November, which was very quick after the election. I think that's really a good sign. And the thing that's really negative here in the headline numbers is the fact that production was still at the 46.8 or so. And I think probably in December, we'll see that get closer to 50 again. And if that kind of breaks the 50 number in January, then we're off and we're running. So, but I think, the environment has been set up very well. We were on a rate reduction cycle. We now have a Republican administration coming into power. They've been very clear about what they want to do. They want to incentivize business to expand. They want to bring jobs back to the U.S. We'll see how that goes. But overall, it's very positive from the business standpoint.
So it sounds like you're expecting a bit of a Trump bump here. I guess the question is more maybe to what extent we'll see that bump?
Well, I guess the only thing I could say is a month or two ago, I thought we were probably in for a grow out cycle in 2025, early 2025. But my comment was I don't see any reason why it's going to be a dramatic grow out cycle like the prior 2016, 2017 grow out cycle that went on until 2019. Now I'm not so sure with the cutting of regulations, the incentivizing of business, the desire to bring manufacturing back, the extension of the tax cuts for individuals, which is important, and probably much more assured with a Republican administration than a Democrat. So I don't know. I think we could have a stronger grow out. We could see a 2.2% grow out starting in the first quarter next year. I don't see why not. I mean, we have a track record for this, including how we deal with tariffs. Tariffs have been a huge talking point for the last couple of months, but the point is that the business community has dealt with these before. We'll deal with them again.
To what extent are you concerned that growth you projected moving forward could become inflationary in 2025?
Well, we'll see. But I think, I answered this question earlier this morning. Inflation was a really big issue a couple of months ago. Both candidates were really espousing inflationary policies. For some reason, it's kind of been diminished since the election. And I think what's happened is that businesses said, hey, let's take the good stuff and let's run with the good stuff. The good stuff is we have an accommodative administration that wants to grow the economy dramatically. It may be inflationary. It may not. We'll deal with inflation when it shows up. We have a person that's designated to watch inflation, Chairman Powell and his team, and they're going to have to deal with it first. And most likely it's not going to show up until second quarter, third quarter of next year anyway. So it's not your primary issue. Your primary issue now is to refill that order book and crank up that factory to start outputting goods again at a level that is expansive month over month. And I think we're getting positioned to do that. I think actually we're about a month ahead of what I would have thought that from a positioning standpoint.
Tim, I'm curious just how your conversations have evolved, or I guess, are you hearing different rhetoric than maybe you were just a few months ago, just about the outlook from those within the industry and what they're expecting here in the months ahead?
Yeah, absolutely. So, I think in the month of September, October, I tracked sentiment based on the comments, and the sentiment was negative, meaning for every one person who was positive, there was 1.5 to 2 people who were not positive. In the month of November, that number went from 1 to 1. So you have 2 people in a room, one person's positive, one person is a little bit cautious. I expect that number to get better in December. The other sentiment numbers that I watch is the hire to fire. And the reduction of employment has been ongoing since May. And we peaked last month at, based on the comments, 1 to 3. So for every 4 people giving me comments, 3 of them were reducing headcount. This month it's 1 to 1.5. So for every 2.5 people giving me comments, 1.5 of them are reducing headcount. So we're moving in the right direction here, I think. The sentiment is positive. We're into the holiday season. Then January comes, it's usually a slow month. There's a lot of activity around updating seasonal factors and stuff. But I think we're off to the races in Q1. The question is whether we break 50 in January, February, or March. I think it's a January or February number.
All right, Tim Fiore, we look forward to having you back again soon. ISM Manufacturing Business Survey Committee Chair. Thanks so much.
Thank you.
Let's zero in on commercial real estate. So far this year, real estate up just 12%, far underperforming the S&P 500. There's a new report out from PwC breaking down the top 5 emerging trends in the commercial real estate sector for next year. And it could potentially be poised for a comeback. Joining us now with a little bit more insight, we want to bring in Andrew Alperstein. He is a PwC partner at PwC. Andrew, it's great to have you here on Yahoo Finance. I think when people think about commercial real estate, there is some hesitation still just about the weakness that we could see within the sector, specifically surrounding office, which I know is just a small subsector within commercial real estate. But I'm curious, why should we, or should investors be, a little bit more optimistic heading into the new year?
Yeah, look, we were really pleased as we published this year's publication. And as a reminder, Emerging Trends in Real Estate is a forward-looking publication. We were really excited about the change in sentiment that we received from the folks that we surveyed and those that we interviewed. And really, it's a recognition that with the Fed signaling lower interest rates and making some reductions to interest rates, we've hopefully got a much more bullish 2025. There's obviously a lot of capital that has been raised and is ready to be deployed. And so, a lot of the fundamentals underlying most property types are still very strong.
You also note, though, that you should be careful what you wish for as one of your trends for 2025. Are interest rates coming down an absolute positive for CRE?
Well, they almost always are. As I mentioned before, with the fundamentals as strong as they are, there is a lot of optimism around a number of property types. And that is really fueling a lot of the optimism for commercial real estate. Keep in mind, we've had 2 very slow years from a transaction activity perspective. And a lot of that was because of the lack of certainty around interest rates and around capitalization rates that inform a lot of how real estate trades and transacts.
Andrew, there's 2 themes that we've been talking about a lot when it comes to commercial real estate when you take a look at the bright spots. One's the ongoing demand for warehouses, and then 2, obviously, is data centers when you talk about the rise of AI adoption. How big of a catalyst do you see that being overall for the sector?
Yeah, no doubt. Data centers, and we highlight this in the publication, data centers have become, really the talk of the town. A lot of tailwinds and positive momentum around data centers, particularly with the Gen AI focus that we're seeing in so many facets of the economy. And so we're expecting really strong continued rent growth in the data center space. The biggest challenge we really have in the data center space is around new supply and the challenges in getting new data centers developed and the limited power connectivity, the limited opportunities really for developers to build as quickly as they need to.
Andrew, for investors that are looking to gain exposure to this space, I think a big question is just the REITs, right? What REITs they should be looking for, what exactly that checklist should look like. Those that are best set up here, in your view, for 2025, what should that exposure then look like?
Well, as you look at a couple of things, number one is we talk a lot in the publication about migration trends and how so many of the Sunbelt markets have been particularly successful and expected to continue to do so, given the migration growth, job growth, economic growth in those markets. You overlay those demographic shifts with some of the property type stories and trends that we highlight in the publication, and you look at onshoring in the manufacturing and space and within industrial. You look at some of the affordability concerns that we have in housing and rental housing particularly. There's a really interesting overlay between some of those migration and demographic and geographic trends, along with some of the property type trends that really start to tell a story around particular investments.
All right, Andrew, we got to leave it there. Thank you so much for joining us this morning. We appreciate it.
Thanks for having us.
Coming up, the cost of immigration policies, how deportations could cause a major disruption in the labor market. That's coming up next, right here on Catalysts.
The incoming Trump administration calling for the mass deportation of immigrants in the U.S. that could have widespread impacts on the economy. Yahoo Finance's Akiko Fujita joining us now with a closer look at the possible disruption to the labor market. Akiko.
Yeah, Shana, the actual impact to the labor market is hard to quantify, in part because there's no clarity on the scale of those potential deportations and how those operations to remove undocumented immigrants would be paid for. The American Immigration Council estimates the cost to carry out any mass deportation operation would top $300 billion. With that said, we can look at the underlying workforce now to get a sense of the potential disruption this would cause. The Department of Homeland Security estimates there are more than 11 million undocumented immigrants currently living in the U.S. 90% of them are of working age. And economists say any removal of that workforce would be disruptive, in part because of the surge in net migration we have seen over the last several years. Now, you take a look at a chart that says it all. That spike you see on the right there at the very top, that amounts to more than 3 million new immigrants that entered the U.S. last year, according to the Congressional Budget Office. And economist Wendy Endelberg, director of the Hamilton Project, says that had a substantial impact on the labor market, boosting job growth by as much as 100,000 per month. The concern, she says, is when you remove a big chunk of those workers who help drive those gains after a period of significant growth, and that creates major disruptions. Now, that impact will be felt across industries, but construction and agriculture are expected to experience the biggest strain. AIC estimates undocumented workers account for more than 14% of the construction industry, while they make up more than 13% of the agriculture sector, with those workers largely employed as crop farm workers. So what does this all mean for you? Well, Jim Tobin with the National Association of Home Builders says any wide-scale crackdown is likely to have a chilling effect on construction activity, driving labor costs higher. Farmers warn about a similar impact to their industry. Groups like the National Farmers Cooperative warning that costs of food will go up further with fewer workers to pick crops. The AIC estimates overall mass deportations would lead to a loss of anywhere from 4.2 to 6.8% of U.S. GDP overall, guys.
All right, Akiko, thanks so much for bringing us your reporting on that. We really appreciate it. For more on the cost of potential deportations, we are joined by Wendy Edelberg, the Hamilton Project Director and Brookings Institution Senior Fellow in Economic Studies, who Akiko spoke with as part of her broader reporting. Wendy, it's great to speak with you here. I want to start on the macro, and then we'll get into some of those individual sectors here. What is the potential broader economic impact of a crackdown on immigration policy, specifically when it comes to something like GDP growth?
Economies generally don't do well with abrupt changes. And this would be no different. Me and some colleagues did an analysis looking at what different kinds of immigration scenarios under a second Trump administration could look like. And our estimate is that if he tried as hard as he could under current law, without Congress's help, to do mass deportations, we'd see potentially hundreds of thousands of people being involuntarily deported next year. And that, along with a bunch of other economic effects and changes in the labor force that would come alongside those deportations, would mean less GDP growth next year to the tune of as much as 0.5 percentage point. And that comes not just from less economic output, because we would simply have fewer workers in the economy, but a lot less consumer spending and businesses responding to that reduction in consumer spending.
Wendy, I think a big question, too, for economists, for investors, really just across the landscape is how likely this is going to be and what exactly the scale and scope of this is going to look like. And I very much know it's hard to answer that at this point, but I'm curious just how you're evaluating that and bringing that into your modeling.
I think it's quite implausible that Trump, even with the aid of congressional action, could deport could have deportations anywhere on the scale of what he promised on the campaign trail. We're not going to see millions of people being deported next year. Just logistically, it's impossible to make that happen. But I do think that if he did, if he took the kinds of actions that he's promised to take, and that state and local officials, across the country look quite amenable to, we could see, maybe 450,000 people being deported next year. And those are big numbers. And then alongside that, I think we would see several 100,000 more people voluntarily leaving. We would make this country a pretty unpleasant place to be.
Talk to me, Wendy, about the economic impact of that, particularly when you look at something like the jobs report over the past couple of years here. You see that labor market growth overall is happening in those areas that have high numbers of immigrants. Is a reversal in immigration policies to a less friendly administration going to potentially stall the growth of jobs and have the opposite effect that the Trump administration has been touting?
Oh, absolutely. So the numbers that we were getting used to in 2023, so far in 2024, putting aside that we've had a slowdown in employment growth in the last few months, we were getting used to numbers around 200,000 a month in terms of job gains. Our economy and our labor market in particular were going quite swiftly. We're going to have to get used, if we have the kinds of deportations that I just talked about, we're going to have to get used to numbers that are a lot closer to zero. We're going to be seeing employment gains closer to, let's say, 50,000 a month in a good month.
Wendy, real quick, we only have about 30 seconds here, but how does this change the wage dynamics?
There are going to be puts and takes. So there's going to be sectors where we're going to see a reduction in labor supply, and that's going to mean higher wages and higher prices in certain sectors. But there are also going to be places and places in the country in particular, that see big reductions in demand. And that's going to mean that firms are also going to want to lay off workers who they had been hiring to serve this immigrant population. So I think we're going to see higher wages in some areas, and we're going to see lower wages in other areas.
Wendy Edelberg, the Hamilton Project Director and Brookings Institution Senior Fellow in Economic Studies. Thanks so much.
Thank you.
Coming up, we've got details on Elon Musk's illegal move against OpenAI. We've got that for you when we come back. Elon Musk is asking a federal court to block OpenAI's effort to convert into a fully for-profit business. It's the latest escalation in an ongoing legal feud between Musk and the company. Here to break it all down, Yahoo Finance's Alexis Keenan. Alexis, what can you tell us?
Yeah, good morning. So what Musk wants here is an injunction. He wants there to be a pause, and he wants to block OpenAI from becoming a for-profit enterprise. And that we knew, right? But he's trying to get a court to set a hearing in January to hear everyone out on both sides to say, let's just pause this for now. We don't want the company to go forward with this. Now, Musk says that OpenAI and Microsoft are engaging in exploitation of Musk because Musk was one of the foundational donors to OpenAI as a charity. He says that they're trying to create a monopoly in the artificial intelligence space that will have irreparable injury to Musk, to Musk's company, XAI, and also for the public, the greater public. So Musk is asking for this hearing. He makes some very specific asks of the court. He wants not only to stop that conversion to a for-profit, but he also wants these alleged agreements that he says exist between OpenAI and its investors. Musk claims that they are blocking, that OpenAI is blocking investors from investing in rivals, including his own AI company. He also wants to stop OpenAI from any benefit that it is receiving from interlocking board members. He's particularly here talking about board members that are on OpenAI, as well as Microsoft's board, with Microsoft having invested almost $14 billion in OpenAI at this point. He's talking about Reid Hoffman. He's talking about Dee Templeton there, though Reid Hoffman is the only voting member on Microsoft's board. Also, the companies, he says, Microsoft and OpenAI, they've already professed themselves to be competitors. So he said that's the monopolistic problem. That's the anti-competitive harm that he foresees. In this motion, I'm going to read part of it. Musk puts it like this. He says, OpenAI's path from a nonprofit to a for-profit behemoth is replete with anti-competitive practices, breaches of its charitable mission, and has self-dealing as well. He says allowing this conduct to continue will harm Musk, XAI, the public. He says Microsoft and OpenAI seized control of nearly 70% of the artificial intelligence product market. We don't know that to be true. We're not exactly sure where he's getting that number. It's an interesting one if he can prove it. Also, in response, a spokesperson for OpenAI called the complaints baseless, without merit, saying Musk will not succeed in asking for this temporary pause.
All right, Alexis, thanks so much for bringing us your reporting on that. Appreciate it. Coming up here, we've got Wealth that's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, it's the first trading day of the last month of 2024, and we're going to talk about some investment strategies through year end and even into 2025. And you got less than a week to make changes during Medicare open enrollment. It runs through December 7th. We're going to talk to an expert about your options if you need to change your enrollment after the deadline. Plus, ahead of Travel Tuesday, we'll talk to Hopper's lead economist about the best deals that you can leverage to save money on holiday travel this month, as well as your 2025 vacations. All that and much more coming up during today's show. But we are 90 minutes into the start of today's trading activity. Here's a look at where markets stand right now. For the USA major averages, we are mixed right now. Dow's down, S&P 500 and the Nasdaq, though, they're holding on to some fractional gains. This as we kick off the first trading day of December, plus the last trading month in 2024. Joining me now, we've got John McClain, who's the Brandywine Global Portfolio Manager. John, great to have you back on the program with us. You're closely watching the bond market, and so what are you looking for as 2024 comes to an end?
Well, our key theme for 2025 is all about the 3 I's, and that's immigration. I think we're likely to see mass deportations like we did in the 1930s and 50s, and certainly that would be inflationary. The second being income inequality. We're looking at policy that points to lower taxes and business-friendly opportunities. That leads to higher stocks, which is owned by kind of the top 10%. And then inflation. And certainly Trump is talking tough on tariffs, and we think investors should be laser focused on the inflationary impacts of policy at this point in time.
And so how will that all play out in terms of what you're anticipating within the bond market, and especially as we're continuing to track as well what the Fed has to do in reaction in order to really get a gauge on how they can continue to combat inflation as they have been trying to do and already set forth that strategy, plus the other end of their dual mandate, which is maximum employment, which it sounds like there's going to be an impact on that if we do see mass deportations.
Oh, absolutely. Look, like post-Fed cut, we've seen the curve shift higher across the back end. And bond investors like myself are certainly becoming concerned that there is a lack of fiscal discipline. That's going to have longer-term implications on asset prices and bond yields. Look at what we're seeing playing out in France. Look at what we're seeing play out in Brazil. The same thing's coming to a theater near you in the U.S. We think absolutely the Fed should, at this point in time, listen to the market. It should be pausing in December. As we said, back-end rates signal higher growth, inflation expectations. U.S. equities are up, and credit spreads are as low as they've been in the last 17 years.
And so all this considered, as you're thinking about the type of duration that investors would be wise to keep in their portfolio, where are you skewing towards?
Yeah, absolutely. At this point in time, we don't think you want to play hero ball in this market. We think that it's an income paradise in terms of what we're seeing in low risk, shorter duration assets, things like treasuries and mortgages, provide, 4, 5, 6% type of yield, which is attractive when you compare it to where it's historically been over the last 20 years. And when you look at equity valuations being relatively stretched. I think most of us are, certainly waiting and anticipating what we're going to see from a policy perspective. So I think it makes it hard to really go much further out on the yield and duration curve. So what we're saying is stay short, stay safe, and wait for an opportunity in 2025, because we certainly think you're going to see a lot of volatility in rates markets in 2025.
John, when you hear about the actions that might be taken from some of the BRICS countries, and of course, as we're thinking about what the response is looking to be and shaping up to be from President-elect Trump, if BRIC countries were to look at the U.S. dollar and say, okay, we're considering our own alternative instead of continuing to place value on the dollar, what does that mean for then the bond market here? And then more broadly, is there a way to play that internationally that investors should be considering?
Well, I think this conversation around the BRICS forming a new type of currency makes no sense to us. I think the dollar supremacy is here to stay. For the foreseeable future, we think the combined GDP of these countries is still relatively small, and their ability to transact in large sizes in a non-U.S. dollar currency would be very tricky. So, this one's much more headline focused than we think reality.
John, always a pleasure grabbing some of your insights and perspective. John McClain, Brandywine Global Portfolio Manager. Thanks for joining us here this morning. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got the co-host of Yahoo Finance Catalyst, Madison Mills. And first up, Maddie, we got to talk a little Marvell Technology here. The company announced an expansion of its strategic collaboration with AWS, Amazon Web Services, and this through a 5-year agreement. Shares rejoicing just a little bit here, up by about 2.8% today.
Yeah, it should flag to our listeners that we're going to be getting a lot of news from Amazon Web Services this week because they are at their annual reInvent conference. So a lot of news coming out on AWS. Look out for that. But AWS here is going to be incentivized to buy more products from Marvell moving forward off the back of this agreement here. As a reminder here, the background of Marvell, their position in the chip space. They design integrated circuits for data infrastructure. That data infrastructure piece is their kind of core competency, and that is what Amazon Web Services will be utilizing them for moving forward here. Notice that I said design, not foundry. They outsource their foundry business. That's what Intel got into a little bit of trouble over. They did not outsource their foundry business. That was seen as potentially a negative move from the CEO, and obviously Pat Gelsinger resigning today. Having said that, going back to this Marvell news, the expansion of this partnership with AWS, not only a positive catalyst, of course, for Marvell, but also potentially for AWS, as this is seen as a mutually beneficial partnership. And you can see both stocks moving to the upside on this news today, Brad.
Yeah, Matt Garman, the CEO at AWS, saying this expanded collaboration with Marvell enables them to deploy some of their semiconductor portfolio, specialized networking hardware to advance their mission to provide the industry's most robust, scalable cloud AI services to their customers. Yeah. Of course, we will see exactly where some of those competitive juices also get flowing, especially with all the announcements that you mentioned are slated to come out over the course of this week.
And we'll have Garmin on the show tomorrow, so we'll be able to talk with him about that too.
Excellent. Next up, while we've got you, let's talk a little VW, Volkswagen, why don't we? Workers walking out of plants across Germany. This is over plans to cut costs from the company as the company's refused to roll out mass layoffs and plant closures, leading to stalled negotiations. Now, this marks the largest walkouts for the German automaker since 2018. Shares reacting, as you would expect, negatively here. They are down by about 1% on this news.
So it's been really interesting to monitor VW because the company has been struggling recently off a lot of headwinds, right? One of them is the drop in demand for EVs, higher production costs. Germany has been in deflationary territory, so some economic headwinds where the company is based, leading to a downward trend in demand. They've also got increased competition from China offering cheaper EVs. They're seeing their own consumers stateside transitioning over to those Chinese EVs because they are more affordable. And now this is kind of the perfect time for their workers to come in and start this stalemate over how the company is going to cut costs, saying they don't want it to come from labor. Now, the union has estimated that the company wants to cut about $1.6 billion in pay from their workers. They obviously are not happy about that, which is why we saw 9 of the 10 VW plants in Germany going on strike here to the tune of about 66,000 workers here. They say, quote, "We are unwilling to accept any plant closures, mass layoffs, and cuts to existing collective wage agreements." So the company will now go into a round of negotiations that's set to start off here on December 9th. So just about a week away, but it's going to be a tough one to kind of come to a conclusion over, given the pressure to cut costs, but also they need their workers in as well.
Yeah, I mean, it comes at a time where there's already this hit on profits for Volkswagen that they've had to disclose. And then let's also think about just the drawdown more broadly of workers for German car companies. More broadly, since 2019, over 40,000, nearly 50,000 jobs have been lost by German car makers. And so all of that in mind with some of the profit pressures, that's certainly going to make this even more contentious on the negotiating front here, Maddie. We're going to continue to track that. Maddie, thanks for sticking around, joining us here on Wealth. Everyone coming up on the other side of this break. It's the first day of the last trading month of 2024. The major averages are all up double digits, tracking for a positive year in 2024. big themes of the year, including the continued hype around AI, moderating inflation, and the Fed's first rate cuts of the tightening cycle that started back in March of 2022. And recently, of course, a big theme has become political policy changes in the coming years following President-elect Trump's victory at the ballot box. Yahoo Finance held its annual Invest conference last month, where we spoke to a variety of Wall Street leaders, and we asked them what they thought the biggest theme to watch in 2025 will be. Here's what they had to say.
The biggest theme I'm watching for 2025 is what the American consumer does.
The biggest theme I'm watching in 2025 is the productivity of the U.S. economy.
The biggest theme to watch for is growth. Where's growth coming from? How much are we getting? Where in the world is it going to be?
How the implementation of the economic growth agenda of the incoming Trump administration rolls out.
Well, I'm really focused on the Fed and on the eco data and on inflation.
State and local regulation around affordable and workforce housing.
How AI can be applied to other industries. So not just an AI for a chatbot or for search, but AI being applied to manufacturing, to health research, to clinical trials, to women's health, and beyond.
The labor market in focus with fresh data out this week. Tomorrow, we'll get the JOLTS report. Wednesday, you've got ADP. Plus, Thursday, we're going to get initial jobless claims. And then, oh yeah, the big granddaddy of them all, Friday, the November jobs report. Joining me now, we've got Jennifer Harity, who is the Indeed career trends expert. Great to have you here on the show with us. What are you hearing from job seekers on the state of the labor market, especially as we're going to be reading through a ton of data to come on the economic front this week?
Yeah, so for the labor market right now, we can see that the labor market has had a much needed cooling, but it's still holding very strong. Now, the month ahead will determine whether or not we've managed a soft landing that economists have been forecasting, or if we're really slipping past cooling temps. Now, as of October, job openings and postings remain above their pre-pandemic level, and the unemployment rate remains at 4.1%. So what we saw is that job growth was minimal in October as the market absorbed hurricane and strike-related disruptions. So it's really up to future reports that are needed to really understand what's going on underneath the hood. So for right now, the soft landing is still on the table, but what we're seeing is a shift to a market where it can really feel like employers are in the driver's seat. So for job seekers, they might find it to be more competitive and crowded, but there are still going to be opportunities for them to stand out to potential employers.
Where are you expecting the most shifts, perhaps in mentality, if any, especially as we think about where there is more opportunity for job seekers and job changers versus stayers?
So with job seekers, what they're really going to be seeing in terms of shifts is within what they can expect from work. And a lot of this is coming from advocates within our Gen Z population. We're really seeing changes in terms of what is considered to be flexibility in the workplace. And a lot of that information has come to us through this new Indeed multi-generational survey.
So let's talk about this. You recently released a survey on remote work and how younger generations of workers are feeling. Talk us through some of the findings there.
Yeah, so it's really interesting when you look at the trends. For Gen Z, they really value radical honesty, and this honesty is needed in both their personal and professional lives. So these are young workers that are showing up in every space as their authentic selves, and they really value spaces where their voices are going to be heard. And from this data, we can see that with this transparency, younger generations are feeling more comfortable discussing their personal lives at work. Some things we're seeing is they are comfortable sharing information about their medical and health information. 63% are comfortable sharing their political views, and 57% are open to sharing information like their cannabis use. So a very open and transparent generation.
Yeah, I mean, look, I even tried sending an all lowercase email recently, and it felt pretty good, just uninhibited. But, all these things considered, one of the major things that they're also, and younger employees are looking for, is work-life balance. What are some of their top priorities there?
Absolutely. So work-life balance is really important. And I think what's really interesting from this data is it shows that Gen Z is actually redesigning the work landscape by doing things their own way. And so they're showing up to work, they're just showing up very differently. So the latest data really kind of shatters this quiet quitting narrative because it reveals that 72% of employees ages 18 to 34 consider their job core to their identity. So this flexible workspace can look like them kind of creating what a flexible schedule can look like. So 42% say they're encouraged by their employer to design their own schedules. 38% are hitting the gym during work hours, and 31% are actually running side hustles.
All right, so that's so interesting. Hitting the gym during work hours, and I mean, look, I've known a couple friends to be able to do that and have time to do that as well as, they're effectively managing their schedule. How and what does that show you about where work fits in to lifestyle versus lifestyle fitting into work?
Yeah, so it's really showing that these younger generations are demanding both, right? They're demanding and really advocating for work that is going to allow them to have this flexible lifestyle. So it's showing that, they're not open or wanting to quit work, especially if the company is instituting a return to office policy, right? They're not opposed to it, but they want that flexibility because they want the flexibility for the things that they value. They value wellness. They value the openness to be able to kind of have this work-life balance, and employers are really responding to it, which is fantastic.
I had seen a study a few weeks back, I want to say, that essentially kind of encapsulated younger workers saying they're not looking for the same type of career progression or climbing the corporate ladder, not the same interest as generations prior. Is that true from what you're seeing, or is there just a way that jobs have changed so much since then and the workplace itself that there may be different things that are prioritized and elevation feels and might look different?
Yeah, so while career advancement may not be their full focus right now, what is really important to them is that flexibility. So they're really interested in kind of having a work schedule within their current work that's going to allow them to attend to all of their needs. And so while advancement might be something that they look forward to in the future, right now they're looking for those opportunities that are going to allow them to design that own schedule, right? To give them that flexibility, because that's something that's really important to them.
Jennifer Harity, who is the Indeed career trends expert. Jennifer, thanks so much for taking the time here with us today.
Thank you.
This is the last week of Medicare open enrollment. If you left your selection to the last minute or have lingering questions about just which plan is right for you, don't worry, we've got you covered. I'm joined now by Philip Moeller, who is the author of Get What's Yours for Medicare. Philip, good to have you here with us today. For those who are still unsure which plan is right for them, what are the top 3 things that people who are eligible for Medicare should consider and the questions they should be asking?
Sure. The top 3 actually fall naturally out of sort of the priorities. The first one is you want to make sure you have access to the doctors and caregivers that you prefer, the hospitals that you want to go to. And for this applies mostly to Medicare Advantage plans, because traditional Medicare lets you see any doctor in the country who accepts Medicare, and most of them do. In the case of Medicare Advantage plans, these plans have provider networks, which have limited numbers of doctors and hospitals in the network. So you need to check the plan that you think you want in Medicare Advantage and make sure the doctors you'd like to see are in that plan. The second thing you need to do is make sure that your prescription drugs are covered in the plan. So if you have a Part D plan, whether it's through traditional Medicare or Medicare Advantage, you want to make sure your drugs are covered. And Medicare.gov, which is a starting place, will allow you to do that pretty easily and will show you all the plans in your zip code that cover the drugs that you need to take. The last thing, which applies to both kinds of Medicare, is that you want to make sure that your out-of-pocket expenses are affordable to you every year. So in the case of traditional Medicare, it means you're going to want to probably have a Medigap plan, which is a private insurance plan that augments Medicare and helps pay for the things that basic Medicare doesn't pay for. The biggest hole in basic Medicare is that it only pays 80% of expenses for doctors and outpatient expenses. In the case of Medicare Advantage plans, they do have out-of-pocket maximums for healthcare every year. So when you look at the various Medicare Advantage plans out there, you want to pay careful attention to what your out-of-pocket exposure is.
Philip, I wonder, what if you need to switch your coverage after open enrollment?
This is a great question, because Medicare has so many open enrollment exceptions and special enrollment periods that they're harder to keep track of than the plans themselves. So the most interesting one to me is that Medicare Advantage has its own special enrollment period that lasts the entire first quarter of next year. So if you're enrolled in a Medicare Advantage plan during the first quarter of 2025, you can switch to another Medicare Advantage plan. If you're in a Medicare Advantage plan, you say, oh, I don't like this, I want to go back to original Medicare, you can switch back to original Medicare. So it's almost like an extension of the enrollment period itself. The other thing, there are a slew of open enrollment periods. The most common trigger for these periods is what I'd call a change in life event. So for example, if you move, you can get a special enrollment period, especially if the new area you're moving to has coverage that's not the same as what you have. Not all plans are available in every part of the country. So if you move, that can be a triggering event. There's a special thing for those of us who have been incarcerated. And if you get out of jail, you get a get out of jail free card, and you can have a special enrollment period for Medicare. Probably doesn't apply to a lot of your viewers, but it's there. And probably sort of the most interesting one to me is that, Medicare has this 5-star quality system where they rate the quality of plans. If you have the top rated plan, which is a 5-star plan, you can enroll in Medicare anytime during the year. It's an 11-month enrollment period. So in effect, you have no end of enrollment period if you want to enroll in one of these 5-star plans. And of course, Medicare likes these high-rated plans. They want to encourage the plans to qualify, and so they give them special advantages in this space.
Philip Moeller, author of Get What's Yours for Medicare. Philip, great insights and tips for all of those out there who are in the midst of open enrollment. Thanks so much for taking the time.
Thank you. Good to talk to you.
Likewise.
Bye-bye.
Coming up, your Yahoo Finance Market Minute. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It's time for Yahoo Finance's Market Minute. A mixed picture on Wall Street today. The S&P 500 and Nasdaq hitting new intraday records while the Dow pushed lower. 3 trending headlines we are watching today. Shares of Block higher after Bernstein lifted its price target to a street high of $120, citing the potential for significant profitability growth. And Supermicro computer stock jumping after an independent review found no evidence of misconduct. That comes after Supermicro's auditor resigned, citing concerns about its transparency. And Bumble shares are sinking after announcing the struggling dating app's CFO, who presided over its 2021 IPO, will step down next year. And that is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
Tomorrow has become known as Travel Tuesday, a day of deals on flights, hotels, cruises, excursions, and more. And with travel booking app Hopper estimating that flights for Christmas are 10% more expensive than 2023, it's a good time to get a deal. Here with her recommendations on the best options, we've got Haley Berg, lead economist over at Hopper. Always a pleasure to grab some time with you. Okay, so we got to run through the top tips for those who are going to be traveling this holiday season and looking for some deals. What should they be looking out for?
If you haven't booked your Christmas, New Year's, any of your December travel yet, tomorrow, Travel Deal Tuesday, is the last day where you're likely to find good deals. Prices typically rise by huge amounts between now and Christmas and New Year's departure dates. So if you book on Travel Deal Tuesday, you're more likely to find lower prices on airfare and some special deals on hotels.
And so it's interesting, especially knowing how much people have tended to spend for Black Friday and Cyber Monday. Does that same kind of mindset and looking for deals for travel, has that held as strong as some of those other heavy spending days, Small Business Saturday, who am I to forget that as well, when it comes to travel in this instance?
We've definitely seen continued spending on travel over many other types of goods and services in the last couple of years. So we're expecting tomorrow will be another big Travel Deal Tuesday with a lot of bookings for hotels, flights, rental cars, even cruises. But it's important to remember the reason why Travel Deal Tuesday began, and it's because travel providers were already discounting their services, their bookings on the Tuesday after Thanksgiving as far back as 2017 when we realized this was happening. So we expect that continue. Travelers are not typically thinking about travel after Thanksgiving. So Travel Deal Tuesday is an opportunity to drum up a little bit more demand for our travel partners. And that's why people are still spending.
All right, so here's a bit of a question that's maybe for me, but hopefully can help some people out there too. When I get to the end of my purchase decision for travel, I'm usually checking that button that says, I don't really need to protect this trip. I'll be all right. I'll make it through. Do I need to be taking advantage of those services? What services should I be adding on if I'm already getting a deal on the travel that I'm booking?
I definitely recommend that when you're checking out, you consider all of the protection options that are offered to you. Oftentimes we see trip insurance, which can cover things like if you have an injury in another country or your baggage is lost, but those aren't immediate solutions. Typically, it takes a few days or weeks to get compensated. Whereas something like disruption assistance, which is available on Hopper and other travel providers, protects you in the event of delays, cancellations, and missed connections, which we know can plague us around the holidays. It allows you to immediately rebook on any flight, regardless of the provider. So if you see a disruption assistance offering, I definitely suggest adding it, especially around the holidays, so that you have some real-time solutions for any of those disruptions.
What are the hottest deals that you're already seeing load up, and to which destinations are really being prioritized for some of the best deals?
We're definitely seeing a lot of international deals. For example, on the Hopper app, we're going to have up to 50% off hotel stays in the Dominican Republic, Germany, 30% off stays in the Cayman Islands. So for travelers who are thinking about maybe one of those bucket list vacations or just getting away to somewhere warm weather this winter, those are definitely some of the destinations we're going to see great deals in.
And then with all of this in mind, how is it really kind of spelling out what some of the trends might be, or at least what some of the momentum might look like coming off of 2024, which at least on the air travel front is looking like it's going to set a new mark to beat after 2023 had already been that major year to top the pre-pandemic markers. So are we expecting this momentum to continue? And if so, what are some of the hot parts of the overall experience economy that could benefit the most?
We're definitely expecting another hot year for travel in 2025. And we don't see this as a post-pandemic trend anymore. This is a real fundamental shift in how travelers, especially younger travelers, are thinking about their discretionary income, what money they have to spend on travel. And they are continuing to prioritize their travel spend, even at the expense of other things. You know, about half of Hopper customers told us that they are going to increase their holiday travel budget by cutting back in other areas. We expect to see that continuing next year, even as some travelers face economic headwinds. And those destinations that are most popular don't come as a total surprise. Hawaii has really been growing in popularity. We're also seeing Italy, specifically Sicily, after season 2 of The White Lotus is super popular. And then Tokyo, Japan is probably the top international destination for American travelers that everyone has their eye on for next year.
All right, temporarily cutting some of those lattes out of the budget for more legroom. Haley Berg, lead economist over at Hopper. Thanks so much for taking the time.
Great being with you, Brad.
Likewise. From purchasing travel on Travel Tuesday to all that money you may have spent already between Black Friday and Cyber Monday and Small Business Saturday, we've got you covered with an expert on keeping your finances in order. Here with some tips on paying off post-holiday debt, we've got David Kimball, who is the CEO of Prosper. David, great to have you here with us. We know that Prosper is an online peer-to-peer lending marketplace connected with people who want to borrow, with people looking to invest. So start us off with your 3 options to help you pay off debt.
Well, I think the best thing you can do is first look at what you have right now. A lot of people have credit cards and you got to take a look at whether or not your credit card is serving your needs. And so when you look at your credit card, are there credit cards out there that have a lower rate that would apply specifically for you? The other thing that obviously for Prosper, personal loans, we think is an excellent opportunity. That's an opportunity for you to consolidate your debt, eliminate a lot of those many credit cards you have, pull it all together at one place, have one payment, have it be fixed in nature, and be able to pay that down. And then to the extent that you have a home, a lot of people will take a look at their home equity and determine whether or not they can do a home equity loan or a home equity line of credit. Utilize that equity you have in your loan. Usually for a secured loan like that, it's a lower interest rate, and it'll put you in a better situation to be able to pay down that loan.
I wonder, what kind of debt should you tackle paying off first? I mean, there's a lot of options here. Take us through your top choices, though.
Well, listen, I think credit card is one of those. I think usually when you're looking at a credit card, there's a minimum payment due there. That minimum payment is usually not enough to begin to pay a whole lot of principal down. The key with debt is you want to get out of it. It's nice to have that around. It's nice to have the option to be able to spend there. It's nice to have that excess supply, if you will. But if you're using your debt, ultimately what you want to do is pay it down, get to a point where you're saving money rather than spending that money. So credit card is the first one that I take a look at, partially because it's revolving in nature, and it's really hard to get on top of that if you continue just to pay that minimum over time.
What are some of the first steps to really pull off a successful debt consolidation?
Well, first you need to take a look at your own budget. You need to take a look at how much income do I have? Once you figure out how much income you have, then let's take a look at what am I spending on? There are certain things that you absolutely have to take care of. You've got to look at your home expenses. You've got to take a look at your utilities. You've got to look at your car payment. Once you've taken a look at that income and you subtract all of those necessities, then you take a look at those wants. If you take a look at all those things and you're spending more than you have, then you know you've got to be able to find ways to either find a side hustle or reduce those expenses. That's really the key, because if you are not changing your spending habits and you just continue to overspend, there isn't a debt consolidation option that's going to be a great item for you other than for a short-term need. You really need to change your habits first, and that's a difficult thing to do, but being honest with yourself, taking a look at your ins and your outs makes a huge difference on your ability to be able to address that need.
No, that's a great point. You know, a popular strategy that we hear about pretty often are avalanche and snowball in trying to pay down debt. How do those work, and how can people choose which may be most effective for whatever their debt situation may look like?
Well, you know, listen, if you look at your overall options there, if you want to do everything all at once, you want to take that avalanche approach, then you need to take a look at something that can take a look at all of your debt altogether. That can be much more difficult to do, because effectively what you're asking for is, can somebody lend me even more so that I can pay down everything? If you're looking at the snowball methods, one of the things that you can do is, how can I pay a little bit at a time? Let me take a look at that most expensive credit card. Let me pay that one down first and focus on that specifically, knowing that you're not going to be able to do it all at once, and it's okay. I think one of the things that happens here is people get very discouraged. They're in a position where they think, oh, this is out of my control. There's no way for me to get on top of this. If you take a little bit every single month and get on top of that, that can make a big difference. You mentioned earlier on one of your earlier segments, maybe I have one less latte this month. Those are the kinds of steps that you need. You don't have to take a massive difference in your approach on your lifestyle, but if you take minor changes, that can have a big impact on your ability to pay down your debt.
David, just lastly, while we have you, what is the debt that will impact or have the largest impact potentially on your credit worthiness?
Well, I think ultimately the debt that has the biggest impact is the debt you're not paying down. So to the extent that you're in a position where you're foregoing payments, that you're delinquent on your payments, that's going to have the biggest impact, because people will look at that. The lenders will look at that and say, listen, this individual is not paying here. Why do I want to extend more lending over here, knowing that they're unwilling to pay on this obligation? The first thing you need to do is get on top of your existing payment requirements, pay those down. That's going to put you in a much better position to be able to get access to additional credit and even better credit.
The CEO of Prosper, David, thanks so much for taking the time here with us today and doing a deep dive on debt and how we should all be monitoring it over the course of this season. Appreciate it.
Thank you.
Let's do a quick check of the markets here as we are more than 2 hours into today's trading activity. Taking a look at the Dow Jones Industrial Average, as of right now, we are just barely in negative territory, but by about 0.25% here. So some fractional declines. We had some year-to-date looks up for you. The Dow still holding on to high teen percentage gains year-to-date. The Nasdaq Composite, those gains there sitting at about 29% year-to-date. And today adding on another percent here as we're tracking during today's trading activity and kicking off the month of December. Also taking a look at the S&P 500, you're seeing those gains year-to-date of about 27%. We'll be generous and round that off to. And the S&P 500 here today is adding about 0.25%. We'll take a look here briefly at some of the activity that we're seeing in these sectors. Right now, technology is leading the pack intraday. That's up by about 1.25%, but bringing up the caboose, you've got XLE. That's your energy sector here. That's down on the day by about 1.75%. And then just lastly here, as we're taking a look, I had it up a second ago. I know you were thinking, wait, where did it go? I wanted to see what crypto is doing. Here's the intraday activity that we're seeing now. Of course, never closes for crypto. So 24-hour basis here, we're seeing Bitcoin down by about 1.3%. But guess what? Yeah, it's still just barely below that 100,000 marker that you were talking about over Thanksgiving and the weekend with your friends and family here. We'll continue to track that for you coming up on the other side of this short break. In honor of Giving Tuesday tomorrow, I know what you were thinking. Travel Tuesday? Wow, that's some dirty work on Giving Tuesday. Well, guess what? We're talking about Giving Tuesday as well. And we're giving you some tips on how your charitable donations can pay off on your taxes. But first, keeping with the consumer and deals, earlier today on Opening Bid, Yahoo Finance Executive Editor Brian Sazi spoke with MasterCard Economics Institute Chief Economist Michelle Meyer about the metrics behind this year's Black Friday sales. And here's some of that conversation.
Total retail spend up 3.4% from this Black Friday relative to last Black Friday, which is a perfectly respectable trend in terms of spending. And e-commerce was really where the force was. So we saw 14.6% increase in online spending this Black Friday relative to last, but in-store was kind of flattish. And I think it's exactly what we spoke about at the top, which is it's a search for value, it's a search for promotions, it's a search for consumers who are looking to make their money work as best as possible and being really targeted and clear about how they want to engage this holiday season. So we saw some strength in apparel in a way that we hadn't been seeing. Footwear also looked like it was doing a bit better, jewelry, electronics. We saw consumers try to grab up a lot of those typical holiday items. And again, in a way that was more meaningful this year than we saw in the past few years.
A programming note: in this week's episode of Financial Freestyle with Ross Mack, tech investor Armando Pantoja talks about what people get wrong with crypto and the importance of the blockchain technology that underpins the market. Here's a clip.
The problem is that most people don't understand what cryptocurrency is based on blockchain technology. The technology of blockchain is what makes everything so secure and so transformative. And the reason why is because blockchain technology is a type of database that is the most secure database that's ever been created. There's almost no way possible to lose data. And 3 is that it can't be tampered with, and there's no possibility for third-party interference. Now, there's no technology on earth that can match that. Now, on top of that blockchain that's when the money transfers back and forth, or the currencies. But the technology is what makes Bitcoin and all other cryptocurrencies so valuable.
New episodes of Financial Freestyle air Mondays at 12 p.m. Eastern Time. Catch them on Yahoo Finance or wherever you get your podcasts. Well, tomorrow is Giving Tuesday. In 2023, Americans gave more than $3 billion to charitable causes over the course of the day. But there are more options than just dropping a dollar into a Salvation Army Santa bucket. Joining me now to discuss some of the many ways to give is Diane Bailey, Bank of America Private Bank National Philanthropic Strategy Executive. Great to have you here with us today, and an early Happy Giving Tuesday to you. As many people are, set to really make charitable donations, how can they position themselves and be smart about donating stock, as that's been kind of tossed around this year, especially coming off of the record runs that we have seen?
Well, thank you so much for having me, Brad, and happy early Giving Tuesday. What I will tell you is that most Americans are not being strategic about the assets that they're leveraging for their giving. We know this because roughly 2% of disposable income is given to charitable organizations every year. And we know that if folks would dig more deeply into their assets, including by considering long-term appreciated securities, that giving would certainly go up. There are huge benefits.
So how does that work when you're going to give or make a donation of stock?
So the first thing you'll want to do is be in conversation with a nonprofit that will be the beneficiary of your generosity. Go to their website, contact a person working in the advancement office, and make sure you get very specific instructions about how to deliver those securities to the nonprofit organization. So they're knowing that they're coming from you, that they're expecting them, so they can appropriately acknowledge and thank you for your generosity. But the great thing about these long-term appreciated securities are the tax benefits. Certainly avoiding the capital gains tax that would be paid if you sold the securities and then donated the cash. And of course, the deduction that you get to take if you itemize your return at the end of the year.
And so what are you seeing in the differences among generations as well, and how they give on Giving Tuesday?
Certainly, there are huge differences in the causes that they're supporting. The older generations often focused on the triple threat of the education, healthcare, and certainly religion, those institutions. But the giving by the rising generation increasingly focused on issues like climate and social justice. Also looking at how they're giving. When we look at how particularly affluent rising generation are looking at their portfolios, no longer are they content with the 60-40 traditional framework. They're looking to assets like crypto, certainly real estate, and often art to really propel their investments, but also ultimately their giving.
When you are making charitable donations, what type of paperwork do you have to have ready or make sure that you're getting back in order to incorporate that within your taxes that you even file for the next year?
Certainly you want to get a contemporaneous written substantiation of any contributions that you're making directly to an operating charity. But the burden of collecting all of those receipts at the end of the year is one reason why we're seeing many of our clients leaning into donor advised funds, making one gift to a donor advised fund, and then leveraging that vehicle to make subsequent recommendations for distributions to charitable organizations at the end of the day. It's a very flexible vehicle. The Bank of America Charitable Gift Fund, for example, is a digitally optimized framework. You can conveniently make those recommendations for the distributions from your mobile phone. And again, very simple from the perspective of accounting and taxes at the end of the year. One receipt instead of multiple.
Relative to history, how are we doing with our giving? Are we more stingy, or are we blessing up for all of those charitable donations and charities that we were just talking about, and different efforts and initiatives that people are really earmarking and saying, you know, I want to make sure that I'm setting something aside to be able to give back and have my own philanthropic effort as well?
Americans are uniquely generous, and they continue to lean into their giving year in and year out. However, we are seeing declines in donor participation. So while the total amount given is holding relatively strong, we had some tough years, certainly with inflation, interest rates, some volatility and declines in the market recently. We do expect this to be a strong year with the performance of the market. But we are increasingly looking to a smaller and more affluent circle of donors to really carry the day.
All right, Diane Bailey, who is the Bank of America Private Bank National Philanthropic Strategy Executive. Thanks so much for taking the time here with us today ahead of Giving Tuesday. Appreciate it.
Thank you, Brad. Pleasure to be here.
Certainly. Hey everyone, let's do a final check of the markets here as we're approaching 12 noon Eastern time. We're taking a look at the Dow, the S&P 500, and the Nasdaq. We are mixed right now. The Dow, the lone laggard, it's lower by about 0.3%. The S&P 500 and the Nasdaq, though, in positive territory. The tech-heavy Nasdaq leading the charge on a percentage basis right now. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Guess what? You could stay tuned for Market Domination. That comes up at 3 p.m. Eastern time with Julie Hyman and Josh Lipton. They'll count you down to and through the market close.